Yeah, someone should take the question for us. The joint venture and the joint arrangement and interest in joint ventures. Yeah, someone should take it for us. Sinagostin, are you there? Okay, Sinadebra, maybe Sinagostin is busy. Can you take it for us?
Okay.
You can
Joint
talk.
arrangement and interest in joint ventures.
Okay.
On 1 July 2021, Football Limited entered into a joint arrangement with Handball Limited to set up an industrial unit. Tennis Limited, with paid-up capital of 50 million Ghana cedis. FL has 60% shares in the equity and operations of TL. The following information relates to activities of TL for the year ended 30th June 2022. On 1st August 2021, CEO obtained long-term loan of 30 million Ghana cedis from a commercial bank to finance an industrial unit, which was constructed at a cost of 80 million. The unit commenced its operation from October 1, 2021 and has a useful life of 10 years. During the year, TO earned revenue of 60 million Ghana cedis, out of which 12 million was outstanding at the year. TO also paid operation cost of 86 million Ghana cedis. TO's finance cost of 4 million was paid by RL, which TL had agreed to settle after the year end. Required. Discuss how the above information could be dealt with in Airforce Consolidated Financial Statement for the year ended 30th June 2022. If TL is treated as A, joint operation, B, joint venture.
Okay. So this one is very simple. It's also part of the consolidation. And this one we have the IFRS 11 that talks about joint arrangement and it focuses more on the joint operation. So if you are given a question like this, you should be able to identify whether this is a joint operation or this is a joint venture. Okay. The joint venture will always involve in establishment of a new entity. So assuming the question has not asked you to assume that this is a joint operation or a joint venture, you will answer this question as what? A joint venture. You can see that Football Limited and Handball Limited are now coming together to establish what? A new industrial unit, which is the Tennis Limited. So joint venture will always result in what? Establishment of a new firm, a new independent firm. That is a joint venture. We are coming together to establish a new firm who is going to carry out its operation independently. That is a joint venture. And the standard says that if it is a joint venture or the company is investing in establishment of a new entity, which is what we call a joint venture, the investment should be accounted for as investment in associate. It should be accounted for using the equity method. How do we use the equity method? It's just like the investment in associates. You take the fair value of your initial investment, you have the share of the profits, any dividend paid have to be subtracted, any impairment loss or something have to be subtracted. So we account for it as investment in associates. But if it is a joint operation, the joint operation means that we are going to carry out an operation that we are going to be having a control or our interest is going to be based on a percentage. And one person can what? Can take a decision without the notice of the other person, or one person cannot take a decision without the other person. And the joint operation does not necessarily involve establishment of a new entity. What will happen is that, okay, we have identified maybe a petroleum site that we want to take care of that particular operation. What we do is that I have resources already. Okay, I have resources already, and you also have resources already. We can now put our resources together to now undertake that particular petroleum operation. That is a joint operation. Or we need some machines to be able to what? Carry out the operation. I will contribute this amount of the machine, you also contribute this amount. It doesn't necessarily involve what? Establishing a new firm on its own. We just identify an activity that we want to carry out the operation jointly. I will use part of my expertise. You also use your part of your expertise. Then we carry out that particular activities. If it is a joint operation, the standard says that you should use partial consolidation. What do we mean by partial consolidation? What do we mean by partial consolidation? Any revenue, any revenue or expenses or assets must be shared based on your percentage holding. So if the company is having 50% of the what of the operation, the person will be taking 50% of the revenue, 50% of the expense, 50% of the asset, 50% of the liabilities, 50% of any other activity that you have over there. We use the partial consolidation. You find your portion of whatever is there. That's what we call the partial consolidation. So joint venture is accounted for as investment in associates. Joint operation, we use what we call partial consolidation. All right. So they are saying that we should assume that this is a joint what? Operation. So the joint operation, we are going to be sharing the assets and also the expenses what? Together. So let's look at the revenue first. Okay. If it's a joint operation, so let's look at this is a joint operation. Okay. If this is a joint operation, what will happen is that you now have your revenue. Okay, so we can do profit or loss item. Okay, what is the revenue for the year? What is the revenue for the year? If you read the question, what is the revenue?
60.
60. So what is your percentage holding in the operation?
60%.
So you have 0.6 multiplied by the 60 million. That will give you your portion of the revenue. What are we going to be having? What are we having? 60% of 60. Okay, that will give us 36.
Hello, sir.
Yes, yeah.
Sorry, but you said since it's they're entering into a new unit, it's like you should treat it as investment in associates.
Yeah, the question says that you should account for it based on these assumptions.
Oh, okay.
So the A and B. So the first one, they are saying that you should treat it as if they are joint operation. How would the treatment
Oh,
be?
okay.
You should also treat it as a joint venture. But if nothing was said, then it will be treated as what? As a joint venture.
Venture. Okay.
Yeah.
Okay. Thank you.
Okay, let's look at the cost. What would be the portion of their cost of sales? Okay, that would be 0.6 times what? Let's go and look for the direct cost, which is the cost of sales. Okay. So there's operating cost of what?
26 million.
Okay. There's operating cost of 26. Okay. There's operating cost of 26. So you multiply by this one to have 26. What are you going to be having?
$15.6.
Okay. What will be your gross profit?
$20.4.
Okay, 20.4. Okay, 20.4. Then you now go and take other expenses. Okay. What will happen over here? You can see that the company also paid the finance cost of what?
4.
Okay, so the finance cost is relating to which company? It's relating to TL, isn't it?
Yeah.
Okay,
Yeah.
so they will take 60% of the finance cost. So we have the finance cost. 0.6 times what? Times 4 million. Okay, let's go to the next one. So the finance cost has already been taken care of. But what will happen is that the finance cost, who pay the finance cost?
RL.
Okay, so it means that FL has to what? Has to pay the 60% to what? To the other partner who is so that the 60% will be treated as a liability for them because those people are paying on their behalf. So they have to refund 60% of that particular amount to them. Okay. Let's now come to our like let's come to or is the old document, the standard document under IFRS and this one is the day two and day three documents. Okay. So let's now come to other issues. Looking at the question over here, do you think there is any profit or loss item in this question again? Is there any profit or loss item in this question? Yes. Is there any profit or loss item on this in this
Oh, no.
particular? Are you sure?
Yeah.
It's
Depreciation.
Interest.
exactly depreciation is
Depreciation
there.
of the.
Depreciation is there.
Mm.
Okay, it is
Um,
the question looks very simple, but it is involving. Okay, depreciation is there. So on August, they obtain a loan to what? To finance the construction of this particular unit. And the unit commence its operation from what? 1st October. Okay, so we assume that the unit is ready for use on 1st October and has been put into operation immediately. So from October to June, how many months is that?
9 months.
9 months. So we have to calculate our depreciation for 9 months. And we know that the cost is 80 million, isn't it? Okay, the cost is 80 million. So we are going to be having a depreciation of 80 divided by 10 times 9 over 12 times 0.6. I hope I'm correct with the calculation.
Yes.
Okay. So what will be the figure there? Okay. That will be 3.6. Okay. So what will be the total profit for them now? I'm having 14.4. Okay. This 14.4 will go to their retained earnings. Will go to their retained earnings. Okay. Let's now count to the profit or loss side. This is profit or loss. Let's count to statement of financial position now. Okay. The statement of financial position, they are going to be having, so we put the asset together and also the liabilities together. So the first asset will be the PPE. Okay. What do you think will be the value of the PPE? What will be the value of the PPE that they will be having?
80 million. No, but
6%.
okay, 60% of 80 million.
Minus what?
Depreciation.
Okay.
The depreciation.
Okay. That is one side of doing it. Another side is so you just do 60% of the 80, which is their portion, but this has been depreciated by 3.6. Or you can find the carrying value of the asset and find 80% of it. Okay.
Oh, okay.
So you can find the carrying value of the asset and find 60% of it. You'll be getting the same answer. So 80 over 10 times 9 divided by 12. So the carrying value will be 80 minus 6. That will give us 74. So you just find 0.6 of the 74. So 74 times 0.6. I'm having 44.4. Maybe if you do it, you'll be getting the same answer also over here. Is it confirmed? Is the 44.4 confirmed?
Yes.
Okay. What is the
44.4.
what is the next the next asset that we are going to be having? The next one. Okay. Let's take your time. You see, this is very simple, but it's complicated. Okay. There will be a liability which is a loan, isn't it?
Yes.
The company will take 60% of the loan. That is fine. The asset, we have done that already. The revenue, we have done that already. Okay. We have done that on the revenue already. And the revenue,
There's
what
12 million outstanding revenue.
okay, which is receivables, isn't it?
Yes.
Okay. So they'll have receivables of the receivables, they are going to be having 0.6 times 12 out of it. Yeah, Sinajan.
Yeah, senior, please check the PPE calculation for me.
Okay.
First, you subtract the depreciation before you multiply, or
The depreciation is 6. It's not the 3.6. The 3.6 is just their portion.
uh, so you subtract that one from
So
the.
you do the product before. No, you do the products before the subtraction.
So you do this one like first before.
Okay.
So
Yeah.
you find their portion and subtract the 3.6 from it. Okay. So the receivables, they will have what? 60% of the receivables. Okay. What will be the value there? I'm having 7.2.
Yes. 7.2.
Let's now come here. The 60 million. The 60 million. How much of it is received as cash?
$48.
Okay. That 48, do we have all the 48 as cash? Do you have all the 48 as cash?
Yes.
Are you sure?
So that we have just 60%.
Okay. Okay.
You can see that
Operating cost.
out of the 48, they have paid for what? Operating cost of 26. So what will be the cash remaining?
Okay. 22.
Okay, that will be 22. Then you now find the 60% of the cash. So the cash remaining will be 22 because they received 48, but they have paid 26 out of it as operating expenses. Okay. Uh, let's go. I'll also come and tell you another presentation that you can do. So you can have the cash of 0.6 times 22. Okay, what am I?
13.2.
Okay, 13.2. Okay. Some of the question can also say this. Some of the question, what they will say is that they won't tell you that the company has paid for the operating expenses. They will say the company has incurred the operating expenses. So we assume that the operating expenses is on credit. So if the operating expenses is on credit basis, then we assume that all the revenue will also be on credit basis. The company can say, oh, the company earned okay, don't worry, I'll go over it. So the question can say that the company has earned a revenue of 60 million. They will not say part of it is for receivables, part of it is for this one. Then they also say they incurred operating cost of 26. What you do is that you find the 60% of this one as receivables, and you also find 60% of this one as payables. You can show them separately. You can show them separately. But what is now happening is that we have receive only 48 of this and we have paid 26. So this 26 has already been paid. We can't treat it as what? As a liabilities that we are going to be paying to those people. So we only have our share of the net cash. So sometimes the question can tell you that these things are on credit basis. So you find the portion of the revenue and treat it as receivables, the portion of the operating cost as well payables. Okay. All right. The statement of financial position, the company is having an asset of 80 million. But this asset was constructed and put into use on 1st October 2021. But we are preparing our statement on 30th June. It means that the asset has been used for some months and the value can never be 80 million at the date of the reporting again. So what is the value? That will give us the carrying value. So we have the 80 million, then we do our depreciation, which is 80 over 10 multiplied by 9 over 12. We have done nine months. That will give us 80 minus 6. We have 74. So this 74, you just find 0.6 out of it. You find 0.6 out of it. Or the depreciation that the company is having a share of is what? 3.6. So you just ask yourself, what is our portion of the asset itself? 0.6 times 80. This is our portion, but this asset has depreciated by 3.6, which is our portion of the depreciation. You will still be getting the same answer. Okay. If you count to portion of the revenue, if you count to the portion of the revenue, 12 million, 12 million is yet to be received. So the 12 million over here is yet to be received. And that is a receivable for the joint venture, or that is a receivable for the other company, which is a Tennis Limited. So anything that belongs to Tennis Limited, we are having 60% of it. So they are going to be having receivables of 12 million. And that receivables, we are going to be having 60% of it. So we find 60% of the 12 million. Okay. It means that the sales made was 60, but 12 million of it is still outstanding. It means that they have received 48 million out of the sales. Okay. This 48 million was received as cash, but the company has paid what? 26 million as operating cost. So the 26 million will be paid out of the 48 that we have. We now have a net cash of what? 22. The company will now be having a net cash of 22. And we will find 60% of this one. So the Tennis Limited has cash sales of 48, but they have paid what? Operating expenses of 26. So it means that they will now be having a cash balance of 22, which we are going to take 60% of it. That's how we go about those three items now. Okay. I'm sure we are done with the asset side. So we move on to the liability side. Okay. So the liabilities, what are the items we bring in as a liability?
Long-term loan
Okay. The long-term loan is how much?
is 30.
Okay. So we have the loan. So the loan, they will be having 0.6 times what? 30. How much are we having as a share?
18.
18. Okay. Then let's count to another one. What will be that one? The finance cost. You see that the finance cost is relating to what? To Tennis Limited. But another person has paid for that particular one. So what will happen is that we have our share of that, which is 0.6 times 4. So that will be the amount that we will be what? We'll be paying to them. Okay, we'll be paying to them now what? 2.4 million, which is the finance cost that someone has paid. Which is the finance cost that someone has paid. If it should be the company itself that has paid the finance cost, then it means that the 4 million will reduce our cash before we share. But it's a different company, or is the other company, or is the other partner who is paying the finance cost. So you have to refund the what? Your portion of the finance cost to them, which is the 2.4 million. Are we okay with that? All right.
Yes.
So this is basically about the joint operation if you're using partial consolidation. Partial consolidation means you just find your the share of the assets and liabilities using your percentage holding or using the percentage of your interest. Okay. If it is a joint venture, it is accounted for as investment in associates. Okay.
Hello, Linus.
Yes, yeah.
Please read the statement of financial position. Are we not going to account for the equity as in the 50 million paid up capital?
We are paying the capital for
TL's
the asset.
portion.
We are taking the assets in return for whatever we are giving to them. So we are putting that money there towards the what? Towards this particular asset.
So I was thinking maybe we will realize some equity.
No. You are using the equity to buy the assets. So it's just like you are paying that particular amount. You are paying that particular amount towards the acquisition of the assets.
Okay.
Okay. So you don't recognize the equity. You just leave it like that. You just use the equity to
okay.
buy the asset. Yeah.
Okay.
But we could account for the 14.4 profit, or
Yeah. Okay. It will come under equity as the company will add it to their retained earnings. That will be the profit for the year. All right. So that will come as retained earnings. I've said that one from the time that we did a statement of profit or loss. Okay. So whatever profit is coming over here will be added to the retained earnings of the company. Okay. But for the equity, it's just like you are putting certain amount of money into the business. What are they going to use the money for? They are going to use the money to acquire the necessary assets. So after acquiring the asset, then you now have your share of the assets. So if they use all the 100 million or all your money to buy the asset, it means that the asset belongs to you because the other person will not have any share of the asset because they are not putting any money towards the acquisition of the assets. So the acquisition of or the share of the asset will just cancel the amount of money that you are putting there. Sometimes the joint venture can be there before you yourself will go and acquire it. So if you yourself you acquire the joint venture, then you have to account for this particular transaction as a business combination. You account for the joint venture as a subsidiary because the two of us establish the business. Now a third party is coming to buy majority of the shares, at least 60% of the shares. It means that particular person is having a control over the joint venture. So if a third party is buying a joint venture, the third party will account for the joint venture under the provisions of the IFRS 3 business combination and also the consolidated financial statement, IFRS 10. The third party will treat it as either subsidiary or an associate, depending on the percentage holding. But if the two of us is coming together, we are going to be using the joint operation and other issues. Okay, please, if you add 0.6 of the capital to the other liabilities and the profit for the year, it balances with the total asset. Yes. You can check and see. If you add 0.6 of the capital to the 0.6, if you add 0.6 of the capital to the other liabilities and this one you are not balancing. You are not here to balance. Okay. You are not here to balance. So forget about the balancing. You are just showing how this particular thing will be done. You are just showing how this particular thing will be done. So you are not here to balance. Okay. So they are just asking you
Hello,
how.
Linus.
Yes, senior.
Please, the 14.4, can you label it?
Okay, I should bring it
for
over.
revision purposes.
Okay, so let me put
So maybe profit before. No, the one here.
Okay.
The revenue, the statement of financial side.
Okay.
The income statement.
Okay. So let me put it over here. Let me also put the retained earnings over here. That will be under the retained earnings will be 14.4. Okay. So that is they're just asking you how this particular thing will be accounted for. After explaining, you just tell them that this is how the other items is going to be shared. That's all. Let's count to if it is a joint venture.
Linus,
Yes, yeah.
typically, if we're not given the circumstances under which to treat this, it would
Okay.
have been a joint operation.
It will have been a joint venture because we are setting up a new company.
Okay.
All
All right. Thank you.
right. Okay. So they are saying that we should assume that it's a what? It's a joint what? Venture. If it is a joint venture, then this will be accounted for using the IS 28. Okay, investment in associates. So you now have your initial investment. Okay, the initial investment is how much?
50.
50.
Okay, so the initial investment will be 50. So that will be 50 million. Then you now determine profit from the operations of the company itself. Not you are not going to share anything. So you determine the profit and find your share of the profit. That is all. Okay. Let's see how we determine the profits. So profit statement. Okay. We are going to be having our revenue of what? 60 million, isn't it? Then we have operating cost of 26. The difference will give us what?
34.
Okay, 34. Then we now have depreciation. The depreciation is what? 6 million. Then we now have a finance cost of how much? 4 million. Okay. So what will be our value now? What will be the profit from their operation?
24.
Okay. That will be 24. So this 24, then we now have our share of it. So share of post-acquisition profit from these people. That will be 0.6 times 24. What are we having?
$14.4.
13.4.
Okay. You can see this is the same as this one, isn't it? Okay. So this 14.4, no dividend has been paid, no impairment. So we just have our 64.4. That is all. The finance cost that has been paid, the joint venture have to refund it to the other person. It's none of our business. We are just accounting for this particular investment as a joint venture. So we just use the equity method. That's all. Okay. So that is it. Let's now move on to our main business for the day.
Hello, sir.
Yes, yeah.
Please, can you go back to the solution again? Just I want to just grab something.
Okay.
No, the second one. Okay, thank you.
All right, yeah. Okay. So let's start with ethical framework, which is 10 marks.
I want to ask a question.
All right, yeah.
The joint operations in terms of consolidation, do you consolidate line by line by line?
No, you can add it to your own activities. So the PPE can be added to your own PPE.
Okay.
Mm.
Linus, please, are you done with the joint venture one?
Yes, please.
Hey.
It's just investment in associate, that is all. You find your profit and have a share of
Okay,
it, that is
okay,
all.
okay, okay. So you take your portion of the profit.
Exactly.
Okay, all right. Thank you.
Sometimes you also have something we call joint control. You see, there are some portion of the consolidation that if they examine it, problem will come. Okay. So sometimes a company can be having a joint control where the two of you will be having 50-50%.
Okay.
So what you do is that you still use the partial consolidation because you people are jointly controlling what? The asset. So you can't say you are the what? You are the owner. So you still
Oh,
use
okay.
the partial consolidation. So you find 50% of the activities, like you just do it like a joint operation.
Okay.
All right. Yeah,
Thank
Deborah.
you.
Hello, sir.
Yeah, Deborah.
Hello, sir.
Yes, please.
Sir, with the joint operation, why why weren't they considering the date or the period which the possibility started? Because see, with the TF, that they bought it on 1st July. So I just don't know whether because they are focusing on the percentage aspect, they also ignore maybe date in which maybe the purchase was made.
I'm coming. Oh, no, purchase consideration, we don't prove it. We don't prove it. Okay. Okay, this one we don't pro rata. You just pay. But maybe the people operation has not started from the time that you paid for the activity. So we don't do anything like pro rata. You are paying the amount and that is the amount that you are paying. So consideration, we don't pro rata consideration. Are you okay?
Okay.
Oh. So let's move on to the main issues. Okay. The the assumption is that it's the football limited that is paying the 50 million, isn't it? Is that the case?
Yes, yeah, the football limited.
Okay. So it's the football limited that is bringing the what? The 50 million, isn't it? Okay.
Yeah.
So let's move on. Okay. So this one they can examine, they brought a question July. There was a question on the joint operation where they were asking that the company is establishing another company with a different company and how they should account for it or something. Okay. And they asked some things over there. Okay, before we move on to another one, I want to say something. You see, if you are contributing, you can say the company is contributing a cash of 50 million, isn't it? Okay. Sometimes the company can contribute a non-monetary item or they can do the contribution in kind instead of cash. So they can do the contribution in kind instead of cash. So maybe maybe they have a patent right maybe they have a patented right that they are bringing asset, not cash. We are just bringing an asset. So we can bring, maybe we have property, plant and equipment. Okay. We have property, plant and equipment in the books, which is 10 million. But we are transferring it to this place, it is 15 million. Okay. What is the gain on it?
5 million.
Okay. You can't say that you are contributing 15 million. The standard says that since the contribution is done in kind, not cash, you can only recognize the gain over here. The gain over here will be recognized based on the what? On the percentage of the other party. So since your own is 60%, you are going to recognize only 40% of this as the gain. So your asset that you are contributing will be the carrying value plus 0.4 multiplied by the 5 million. That's how we do it. If the contribution is done in kind, you can only recognize the gain on the what? On the item based on the what? On the percentage holding of the other party. So the contribution that you'll be recognizing as you are making will be 10 plus 0.1, 0.4 times the 5 million, which is the gain. You find only 40% of the what? The gain and add it to the carrying value of the assets. You have to take note of that one. All right.
Hello, please explain that part again.
Okay. If the contribution is done in kind and there is a gain on it, the gain can only be recognized to the extent of the percentage holding of the other party, not your own percentage holding. So if you're having 50%, it means that you recognize 50% of the gain on the asset. Then you now add that portion of the gain to the carrying value. If you're having 70%, you can only recognize 30% of the gain and add it to the what? To the value to the carrying value of the asset that you are bringing. Then that will be your contribution. That will be your contribution, or that will be your investment. If you are doing investment in associates, that will be your investment. Okay. Let's now take the Okay. Let's now take the ethical framework. Let's take this very simple question. We digest it, then we move on. So, Deborah, help us with that one.
Ethical framework required. Briefly explain how CFO may be in breach of fundamental principles of ICAPS code of ethics of said accountant. Also state the potential threat that you may face in the above circumstances and how you should respond. You have recently joined a finance manager. You have recently joined as finance manager of Soccer Limited SL, a football manufacturer, being one of the sponsors of the upcoming World Cup in Qatar SL. In Qatar, SL delegation have been invited to watch few matches of the World Cup in the stadium. You have been informed that the statutory audit of SL for the year ended 30th June 2022 is in final stage, and the auditor has recommended certain material adjustments in the financial statement before issuing an unmodified audit opinion. In a meeting with CFO, who is a chartered accountant, we have been informed about the disappointment of Excel's director due to the selected audit adjustments with which slide Excel's profit below the target. Therefore, CFO has asked you to pick up the matter which the audit engagement partner regarding the selected adjustment, and also asks you to invite the audit partner to a trip to Qatar with Excel's delegation. Required. Briefly explain how CFO may be in breach of fundamental principles of ICAP code of ethics of chartered accountants. also speak to the potential trend that you face in the above circumstances and how you should respond.
All right. So the question is specifically talking about what? The fundamental principles, isn't it? And the fundamental principles, how many do we have? How many of them do we have? The fundamental principles.
5.
Okay. And the ones that will always be breached are what? There are 3 of them that no matter what, they will be what?
Objectivity.
Okay. So even if you don't know what the question is saying, you can list your fundamental principles, the 3 of them, and just use the statement to say something about them. Okay. So the first one will be what? Objectivity.
Objectivity.
Okay.
Integrity.
Okay. Integrity. Then we have,
Professional behavior.
okay, professional behavior. These 3 there, wherever you go, they will be having a problem. Okay. So you can look at these 3, you can write these 3 down. Even if you don't know what to say, you can say something about their meaning. Then you use something in the question there to say something like, okay, it's because of this and this, or because of this and this, there'll be an issue of objectivity, or there'll be an undue influence. Something. You don't leave the space open. Write something there and move on. Whatever the ethics question will be, these particular 3 principles will be having a problem. So just have these 3 in your mind. Then you read the what? You read the case given to you and see where you can say that there will be an issue of objectivity. The objectivity means that the professional accountant should be what? Should be honest. The professional accountant should be a professional, should not allow issue of undue influence, should not allow issue of
Yes.
bias to override his professional what? Judgment. Don't say that this is my wife and this is this and this. You have a personal relationship with a person. So you allow your personal interest to what? To override your professional judgment. The integrity has to do with you being straightforward, you being honest. Don't support what something that is very bad. Don't give false information. Don't support something that is not truthful. Professional behavior has to do with that. You should not engage in activities that will say something bad about your profession. Your profession, you say that you belongs to what? The Agencies of Chartered Accountants Ghana. You are a member. And now a member, whenever you have a free time, you go and sit at a chop bar, drink and boost. No, if they look at you, see, he's calling himself a chartered accountant. Look at what he's doing. You are engaging in activity, or you are engaging in behavior that will say something bad about a profession. So those are the things that you have to, as soon as you understand these particular principles, you can try to link it to what? To the case given to you. So let's go and take the case again and see where there will be an issue of objectivity, and there also be an issue of what? The integrity and also the professional behavior. Okay. So you have recently joined as a finance manager of Soccer Limited, a football manufacturer, being one of the sponsors for the upcoming World Cup in Qatar. The SS delegation has been invited to watch few matches of the World Cup in the stadium. Okay, so these people are
Yeah.
what?
Hello, Linus. Sorry.
Yes.
Please, where are you reading the question from? The document 1 or the document 2?
No, I've shared a different one, which is the final one.
Oh, okay. Okay.
Yeah.
Thank you.
Okay. So they have invited some of the what? Some of the league. Okay, so this particular company are one of the what? One of the sponsors for the upcoming this one. SL delegation has been invited to watch few matches of the World Cup in the stadium. So some of the delegates from there, maybe it can be the board of directors, some of them from the those key positions are being invited to come and watch the matches in this one. You have been informed that the statutory audit of Excel for the year ended 30th June 2022 is in final stage, and the auditor has recommended certain material adjustments in the financial statement before issuing an unmodified audit report. In a meeting with the CFO, who is a chartered accountant, you have been informed about the disappointment of the SL directors due to selected audit adjustment, which slide SL's profit below the target. Therefore, CFO has asked you to take up the matter with the audit engagement partner regarding the selected adjustment, and also asked you to invite the audit partner to help to the trip to Qatar with what? SL delegations. What is the matter here? What is the matter? They say you should briefly explain how the CFO is the CFO. The CFO is a member of a professional body. So you should explain why the CFO will be in breach of the fundamental principles of this supposed to be ICAG Code of Ethics for Chartered Accountants. Also state the potential threats that you may face in above circumstances and how you should respond to it. Okay. Do we agree to the issue of objectivity? Do you agree to the issue of
Yes.
objectivity?
Yes.
Okay. What is going to trigger that particular principle not being
Okay.
abided by?
According to the Alpha Code of Ethics, objectivity is where the professional accountant shouldn't be under any influence or under any undue influence, conflict of interest, or shouldn't be biased in his decision making. And in this regard, the CFO, who is a board member, will definitely get some bonuses when they meet their targets. But because when these targets are not met, maybe he won't get those benefits, which I will regard as conflict of interest. He says that when these modifications are done, their profit is going to reduce. So he informed the finance manager to talk to the audit engagement partners so that those modifications will not be done.
Okay, so that is okay. That is okay. You can see that clearly the CFO want to influence the decision of the auditors. Okay, they want to he want to influence the decision of the auditors. That is why he is asking you to invite them to the trip to Qatar. Because if I'm your audit partner and you can imagine taking me to Qatar. So I cannot follow you to Qatar and come back and mafia you again. So he's trying to influence the decisions that those people or the audit partners are going to make, and which is if those decisions are being made, he's not going to get whatever he will be getting from the performance target. But he's trying to use that trip to influence that decision for his own personal gain, which is he wants to get the bonus on the target that the company is setting. The case specifically states that if those modifications are done, or if those adjustments are being applied, it is going to reduce the profit, and the target will not be met. So you want to influence them so that those people will also overlook whatever opinion that they are going to be giving, or whatever adjustment that they are going to recommend that should be implemented. They can actually ignore it and their profit will go up. All right. Senior Alexis.
Okay, Linus,
Yes, senior.
please, I want to find out whether the undue influence under the objectivity has to do with the accountant being influenced or he influencing somebody.
Okay. It depends on who is in the situation. If you are a member of a professional body and you are influencing somebody, then you are also not obeying the principle of objectivity. And you, the one that they are using that particular influence to influence, if the influence has actually influenced you, you are also not going according to the principle of objectivity. So if the two of the people are all members of a chartered account, members of a professional body, any of them who is being influenced, who is influencing, the person influencing is not even going according to the objectivity. It shouldn't be the person in question. It's not being the person who is being influenced. The person who is influencing will also not be adhering to what to the objectivity which is under the professional code of ethics. Because you are a professional member of an institute, you are not expected to what undertake activities that is not going to say something good about the profession. So if you are trying to influence, even if you are giving bribe, if you, the finance officer, you are giving bribe, we can also say that you are also having issues with objectivity because you are giving the bribe for personal gain. Why are you giving the bribe? Because you have done something bad and you are trying to give bribe to the person not to reveal that particular thing. So you are giving the bribe for personal gain. So it doesn't matter who is not the only person who is being influenced. No, you're also influencing the person that is using.
Okay, thank you.
All right, so you can also be seen as not going according to the principle of the objectivity. All right. What again? Can we say that there is an issue of integrity?
Yes.
Okay. To what extent?
The extent that the CFO is asking that the partner be added to the trip. Because if you are straightforward and honest, I mean, and be a member of such a profession, what you know the issues the audit firm is raising, and you know to what extent they affect the numbers. So you just accept them, and then the right thing is done. But for you to cut corners, then you have integrity issues.
Okay. All right. That's cool. That's cool. That's cool. That's cool. That's cool. All right. Any
Okay.
addition?
To add to what my brother said,
Yeah.
being a member of a professional body like this, you should know that the auditor is supposed to be independent of the organization.
Okay.
Now they have raised their issues. You are supposed to look into the issues and rectify the issues.
Okay.
Now you are trying to kind of influence the auditor by taking him on a trip. So you can see that the intention of the CFO is not an honest intention.
Okay.
Yes. So that is how I also look at it, in addition to what my brother has said.
Okay. That's cool. That's cool. That's cool. So like
and also with what he said, that also compromises the professional behavior, whereby it's actually going contrary to the profession.
Okay.
The CFO is actually disgracing the profession, because if an auditor will perform his work, and you the CFO to cut corners to please yourself, at least you are not making the profession, or you are not exceeding the name of the profession. So it goes contrary to the professional behavior of the CFO.
Okay. That's cool. That's cool. So the question I want to ask is that, is it that in the exam hall, like that because of fear you forget these things, or what? Because I don't know why you can't get 10 marks for ethics based on what you're saying.
Linus, last sitting so there, it seems it took a different dimension.
No, forget about whatever they are saying. Forget about whatever English that they are saying there. Just write your objectivity, your integrity, your professional behavior. Then you look through and see whether there will be an issue of confidentiality or professional competence and detail. If you can't see there, then write a thread. You can start, because you don't know what to write. Start by explaining those things. Just put the meaning there. Come and look through what they are saying, the case is saying, and see whether there can be any issue of personal interest and those things. Yes, just capitalize on them and use them and write. That is all.
Hello, Linus.
Yes, yeah.
Okay, so what you are saying is true. However, of late, the kind of ethics questions they have been setting is like they are testing our minds on the IFRS more than the normal, principles.
Okay.
Even though you talk about the normal principles, some of the questions, if you don't know how the issue is treated as per the IFRS, now why you have trouble? So, what about that one too?
That one, God will intervene. You can write the theory part and leave the calculation part for the God. God will intervene. Okay, so yes, that confirmed that right now they are changing the dimension of the corporate reporting. They want to make it full of standards. If they have the time, they can set the question from question 1 to question 5 full of standards. Okay, but whatever be the case, just pick your the last sitting one. I didn't actually see the question. I didn't see it, but whatever be the case,
It took a different dimension altogether. What they were
Even
requesting for,
sometimes,
if we
yeah,
look at the
sometimes
solution, it was different from these ones.
and even you see this case, you even think that they should rather ask about the issues concerning the partner, but they're asking about the CFO.
Yes.
Claro, if you read the chief examiner's report on the ethical framework,
yes, please.
what he was saying was that this one was not a normal, the 5 ethical principles. There were issues that were practical, and that you were supposed to see them in the context of the practicality, and not necessarily that people were writing the ethical frameworks.
Okay.
That's what the chief examiner is saying.
Okay. You see, you can still write the ethical framework and use the practicality to explain it.
Okay.
Okay. You see, sometimes the question will you see, this one, we don't have enough information from this particular case. That is why we are using our own assumption to answer the question. Okay. Sometimes they can give you a full information and there will be some certain adjustment that will be done over there. Maybe inventory has been overstated by this amount, but the CFO is now like he's hesitating to restate or to carry out the adjustments. Okay. What you have to do is that before you can answer the question, you first have to talk about the implication of what he's trying to do, the effect that that particular thing will have on the profits. So you talk about, okay, the CFO is trying to do this particular thing. If he does that, the profit is going to be increasing like this. And that will be giving a false information about the company to the directors or to the users of the financial statement. And people can, based on this financial statement, and make wrong decisions. Okay. If you talk to the finance director, maybe you are the account intern. If you talk to the finance director, you know that he will not accept this. He will say, "Who are you?" Because he's your boss. And if care is not taken, he can be threatening you that if you don't want, you are just intern. Who are you to come and teach me these things? These are the threats that you have to talk about if they are talking about the threat issues. But if you have issue about the standards, you talk about the standard. How should the standard be applied? If the person fails to apply it, what will be the effect on the statement of financial position? If the person applies it, what will be the best position? And although I haven't seen the last sitting ethics question, but if they are now changing it to standards, then that is another issue. That is another issue.
That thing crowd wasn't about standard, so Charlie wasn't you just look for it and see.
Okay. Because the last thing I tried to solve the financial reporting one in class. It was also some inventory something, and they are asking about the 5 ethical issues. I hope we solved that one in class, but for corporate reporting, I wasn't able to have access to that particular one. Okay. All right. So let's start with the.
So, Lionel,
Yes, yeah.
so after talking about the ethics,
Okay.
the code of conduct, I think there's a second part to the question. Also, see the potential threat that you may face in the about and how you should respond.
Okay. So that one they are talking about you as the new person that joined the finance company. So you, the finance manager, you, the new finance manager, they are talking about a threat that you will be facing as a result of this. You see, some of us, it's more like we don't want to do the right thing. No. It's because of the situation that we find ourselves. Okay.
Yes, we are intimidated.
Yes. So look at this finance manager. You just joined. You have families of 5. Your mother depends on you.
Financial interest.
You can imagine. You'll be willing to do the right thing, but your boss will tell you that you want your job because he's the CFO. He's the CFO, and he might have connections. Even if you report to the people at the top, and that issue will not get anywhere. You end up losing your job. So the first thing is that you might be intimidated that if you don't do it, if you don't do it, then you can they will even tell you that you will not go to the Qatar again, or from Qatar, come back and pack your things and go. That's another threat that they will give to you, that if you don't want to do it, this is the issue. If you don't want to do it, you come back from Qatar, and that is the end. And your CFO can even hurt you for that. He will say he will not talk to you again. So there will be an issue of intimidation threats, because you say that this thing you can't do it. You should let another person do it. He will tell you that, do you want your job? Do you like your job, or what? So there will be an issue of intimidation threats over there. He can also offer you some
And also even self-interest.
Yes, he can give you some offers that, okay, if you're able to convince them that we get this one, I'll give you this amount. So there will also be the self-interest threat there in terms of financial interest. They will say, oh, they can offer you some certain amount of money that if you're able to convince them, we will give you this amount, or I'll give you this amount of this, or I'll help that they will promote you, or within this and this, you will increase your salary or something. So there will be an issue of self-interest over there. So the self-interest will be there, the intimidation interest will be there. What else do you think will be there? What else do you think will be there? You will see that if you are talking to the auditors, you try to protect the interests of your company. We are going to be talking
advocacy threat.
Yes, advocacy threat is also there. So you also try to act as a mediator, or an advocate for your company. You'll be talking on their behalf. Oh, this thing is not anything. Oh, this thing we have been doing it. Oh, this thing and this. You will try to advocate for the wrong thing. If you're advocating for the right thing, we don't have a problem with that. But if you are trying to promote the interest of your partner or your company beyond the normal, in the wrong direction, then you are trying to have issues with what we call the advocacy threat. But a self-review, you are not the one who have done the work, and you are not the one who is coming to review the work again. No. For the familiarity, you just joined. You don't have any problem with those people, so you just joined. So those 3 issues might be there. Those issues might be there. You don't have information to see whether this particular person has been offered financial assistance or have been offered anything, but it is likely that these things will be there based on what we are reading. All right. Let's look at the question 1, which is a very interesting one. Let's look at it and see how we can go about it, and the interpretation and also those issues. All right. So if you see a question like this, the first thing is that, okay, for the specialized transaction, you have 2 major topics there. It will be from November that they will now bring preparation of financial statements for insurance companies and other companies. But for now, it is business valuation and capital reorganization. But from November, they will be adding new things to it. So what I'm trying to say is that if you don't want any issue, try to get it before November. Because if you come to November, there will be issues that you'll be preparing financial statement for insurance companies. You will still be using the standards. It will just be like final accounts. They will bring issues like final accounts, because they say you have to prepare for other companies, banks. You prepare financial statements for banks. So you'll be having some standards over there. So the special transaction, we have the capital reorganization or liquidation. Sometimes the question will ask you to design a scheme. So to design a scheme means that the company is making a loss. The first thing is that, okay, if we sell the asset or if we decide to close down the company, can we be able to get some amount of money and send it to the house after settling all our liabilities? So if the company is making loss and they say you should design a scheme, they will always give you some breakout values. Breakout value means if you want to liquidate a business today, what value are you going to be recovering from your asset? If you sell your asset, what value are you going to be getting, which we call the resale values? They'll be giving you breakout values, and they'll also be giving you some revalued amounts. It means that they are asking you to do two things. You should assume if the company wants to liquidate, what will be the position? If you are liquidating, the only time that the shareholder can accept the liquidation option is that after settling their liabilities, after selling the asset to settle liabilities, there is something left for them also to put in their pocket and go to the house with it. But if the money that we are realizing from the sale of the asset is not enough to settle the liabilities, it means that if we should close down a business, we are also not going to get anything. So we cannot accept that. Liquidation will always be accepted if all the shareholders are satisfied. The preference shareholders will get something, the ordinary shareholders will also get something. And mostly in the exam, the liquidation option will never be favorable because nothing will be left for the equity shareholders and also maybe the preference shareholders. The remaining of the things will be on the unsecured creditors. They will be the people that will always share the remaining money. It will not get to the preference shareholders and then the ordinary shareholders, and they will never accept to lose their investments. So they will now say, okay, let's see whether we can do something about the company to go back to our profit-making ways. They want to reorganize. They want to restructure. They want to reconstruct. So you will now look for the reconstruction option. And the question will always be, or will always emphasize on the reconstruction. Okay. But business valuation is not likely because they can't examine business valuation for 3 consecutive times. How? Why? Okay. But
So that's what we thought last night too.
yeah, well, for the last night, I wasn't that sure that business valuation will not come. Okay. I wasn't that sure. But how can you bring business valuation for 3 consecutive uh times? It's anything can still happen. We have done the business valuation. Okay, so you just have to revise. But anything can still happen for this one, but it is likely to be capital reorganization. It is likely to be the capital reorganization. The reason why they are bringing the business valuation right now is that they are trying to put standards in it. So they are trying to put standards in it. That is why they are bringing it because those days the business valuation does not come like that because it is just like the normal business valuation. But right now, since they are examining standards as part of it, they like it more than the capital reorganization. Okay. So you first ask yourself, it is if they are asking you to design a scheme, you have to design a scheme. You only go for the liquidation and reorganization if you are giving information on the liquidation. So sometimes they will give you the sellable or the resale values of the company. It means that you also have to go for the voluntary liquidation first. Then you now go for the reorganization portion. But if you're not giving any information on the liquidation, then it means that you just do the reorganization and that is the end. So the business valuation, it will always be the valuation of the assets. So we use the net asset method, we use our price earning ratio method, we use our dividend yield method, our earnings yield method, any other method that you can think about. Okay, but this evening we are going to look at the capital reorganization. And it's a very simple and interesting question. Okay, Sinadebra, if you see a question like this, what is the first thing that you have to do?
We'll read the requirement and see what they're asking us.
Requirement, they are giving you statement of financial position, isn't it?
Yes.
Okay, the requirement will always be prepare statement of financial position. Okay, for these ones, for the theory questions, I'll give you a certain document so that you can use it to answer them. The answers are there, so you just read them. Okay. So the question will always ask you for statement of financial position. Even if they are asking you to go for voluntary liquidation, you will still prepare statement of financial position, assuming the company want to restructure. You prepare the financial position based on restructuring, because if you are liquidating, the business will no longer be there. Okay, so whatever be the situation, you will still prepare the statement of financial position. So you can start by putting your items there. You can start by putting your items there. So you can start with your equity and liabilities. Then if you like, you can put your ordinary shares in brackets, or you can go and do workings for it. You can also start with your cumulative preference shares. You can also put in the bracket. Retained earnings will be written off. Whatever be the case, retained earnings will be written off. All surpluses or all retained earnings will be written off. All intangible assets will be written off. All fictitious assets will be written off if you are doing restructuring. You can't be making a loss and say you still have a good year. How? It is not possible. So you have to write them off. You have to write them off. So let's start with this particular one. So let's just put the items there. Then we now come and take the footnotes one by one. Okay. Okay. So not for the year, assets. Sorry, it should always be assets. Or you can say immediately after the reconstruction or immediately after the scheme. Okay, you have to know that if you are doing reconstruction, there are certain accounts that you cannot deal with. You cannot deal without. Okay, there are certain accounts that you cannot do without. One of them is the capital reduction account. You see, if you are doing reconstruction, you will now be bringing the business as a new business. So you have to revalue the assets. So the revaluation of the asset may result in a gain or a loss. So how do you determine the loss? The loss will be determined from the capital reduction accounts. So let's prepare the way it is given to us in the statement of financial position. So equity and liabilities. Equity and liabilities. So we have the ordinary share capital. Okay, what is the value for the ordinary share capital?
320.
Two. Okay. 320.
320.
Okay. Okay. The next one is what?
10% preference share.
Or that for them there is no difference between them. For the maximum loss, we use the vertical method to determine it. For the capital reduction, it's just the maximum loss that we are determining, but we use the T account. So the capital reduction and those ones, they are all the maximum loss. But one of them, we do it on the vertical account. So me, mostly, I use the T accounts. So the figure that you'll be getting over there is still the maximum loss for the capital reduction account. But we call it, if you are doing liquidation, that is why we call it maximum loss. But you can still say you are preparing capital reduction account. You will get a maximum loss from the preparation of the capital reduction account. So the account that we are using to determine the maximum loss is what we call the capital reduction or the capital reduction account. So there's no difference. There's no difference here. If you use the account and then the vertical, you'll be getting the same answer. But the loss over there is what they are saying the maximum loss. The loss you'll be getting after preparing the capital reduction account is what they are terming as the maximum loss. See, now I hope you're okay. All right. So we have the 10% cumulative what? Preference shares. What is their value? Okay, it's 80. Okay, then we now have retained earnings. Retained earnings is negative 248. Okay, let's now go to the other items there. We have non-current assets. Non-current assets. We have 15%. 15% debenture. Okay, we have current liabilities. Yes, Nia.
Yes, the return earnings you are putting there. Why can we just remove it completely, or when you put it there, will you get some text on it?
Or I
Because we
mean,
are,
you come and remove it, so you can do minus the plus 48 there to remove it. Maybe they can give you six. I
and then
can't. Yeah, I can't really tell. Okay.
well, when you look at all return earnings and capital reserves,
Yeah, yeah. So you can just put it there to come and show that you are removing. Maybe there can be a six over there. All right.
okay.
All
All
right.
right.
All right. So we have the current liabilities. The current liabilities, we have the trade payables. The trade payables is 188. Trade payables is 188. Bank overdrafts of 100. And what is the next one? Director's loan. Director's loan. Director's loan of how much? 68. So we now have assets. So the assets, we have non-current assets. Non-current assets. We have PPE or tangible assets. Okay, the PPE is how much? 404.
404.
Okay, 404. Then we have development what? Expenditure to be 88.
88. Yes.
Okay, the next one is what?
Asset.
Current
Current asset.
Okay,
612.
current asset is what?
216.
Okay,
216.
okay. So we can now move on to get our footnote one by one now. So the first account that you have to prepare is the capital reduction what account. So the workings will be so I'm not sure this area will be enough for capital reduction account, but let's start. If the space is not enough, we can go and create a different space for it. Okay. So let's take the question now one by one. The capital reduction account works like profit or loss account. So just take it like that. It is just like profit or loss account. So if you take the transaction, you ask yourself, this transaction, is it going to bring a gain or is going to bring a loss? If it is a gain, it will be credited to what? The capital reduction account, because it's just like profit or loss account. Profit will be at the credit side. Loss or expenses will be at what? The debit side. So let's now take the footnote one by one. Deborah?
Okay. Footnote 1. A. All retained earnings and capital reserves are to be eliminated.
Okay, so the first thing is that they are asking you to remove the what? The retained earnings. The question is the retained earnings a positive figure?
No, that's a negative figure.
Okay, so if the retained earnings were to be a profit and they are asking you to remove it, would that be a loss to the company or it would be a gain?
A loss.
Okay, but now it is negative. It's just like an asset to the company.
In the first place, if it is positive, would there be the need for recapitalization?
No, there will not be a need because
Yeah. Oh.
we are not doing that. We can't do restructuring. Even if you want to do restructuring, to just be management restructuring. Okay, they just want to change management. Okay, but you can see that the retained earnings is what? It's negative.
Negative.
It seems like the shareholders are owing the company. It seems that the shareholders are what? Are owing the company. Okay, now they are saying that you should write this off. Would this be an expense to the company or it will be a loss? Would the retained earnings?
To be a gain to the company.
Are you sure?
No, it should be a what's the name?
It's a loss.
It's
It's
a
a
loss.
loss.
The retained
loss.
earnings over here.
We are writing it off.
Yes.
We are writing it off for earnings, so it should be a gain to the company.
No, the retained earnings over here is negative. This can be treated as an asset.
Okay.
This is negative. It's more like you not subtracting it over here, but bringing it as an asset.
Okay.
Okay. So this is an asset that you are writing the asset of. That is a loss to the company. So retained earnings will always be expense. Writing the retained earnings off will always be the expense because it will always be a loss. So you come here with the retained earnings. How much is the figure? 248, isn't it? Okay. So you just go here and add the 248 to it so that you can make it 0. Please, you are working with time. Don't go there and be preparing account 11111 for each of the items. No, you are going to waste time. So sometimes you can just think through the thing and write the figure. You don't have to go and do a double entry. The balance brought down on the debit side of the retained earnings account. Then you put capital reduction at the credit side. Then you say that if capital reduction is at the credit side, then retained earnings must be debited to capital reduction account. No, you don't have time to do all these workings. The major workings that you can do is the capital reduction account, ordinary shares account if the issues about the ordinary shares are plenty, the cash account or the bank account if issues about bank or cash is plenty. That's all. But the major working is the capital reduction account. You don't have to prepare this plenty account, no. Okay. So the first one is that we have written the retained earnings off. Let's move on. There is no capital reserve there. Sometimes the question can give you capital surplus. So whenever you are writing the capital surplus off, the capital surplus can be positive over here. So the question can give you the capital surplus of 48 over here. So it means that you are going to write off the capital surplus against the retained earnings. So you only send 200 to the capital reduction account as with the retained earnings because you are written 48 as a gain against it. That's all. All right. So we don't have anything over here. So we move on to what let's come to this, please.
B.
Yeah.
Mole's director have agreed with a national development bank to allow the entity to obtain a 3-year term loan facility worth 200 million Ghana cedis at a subsidized interest rate of 14% on the condition that the company stays in business over the next 5 years. The loan is repayable at the end of the 3rd year, while interest is payable annually in arrears. Without such arrangement, Imole would be charged an annual interest rate of 40%. The loan will only be available if a successful reorganization is concluded. 60% of the total proceeds to be used to buy new production machine.
Right. What are they saying? You can see that they are giving a loan at a subsidized rate, isn't it? Okay. The loan is being given at a subsidized rate, and the loan is also given on a condition that a company stays in business over the next 5 years. Whenever a loan is given at a condition, you have to know that the loan is having an element of grants. Whenever a loan is given at a subsidized rate and it is given by a development bank or a government of a country, you have to know that the government is giving a grant to the company, which is included in the loan. How do we determine the portion of the loan that the government is giving or the development bank is giving? You can see that this is National Development Bank. National Development Bank. They are there to help people. If you are having issues, cash issues, they can help you by giving a loan to you at a subsidized rate. They can help you by giving a loan to you at a subsidized rate. The meaning is that if you should go to somewhere else to take a loan, the loan will be given to you at a commercial rate of 30%. So if you go and take the loan from different places, the interest rate will be 30%. But for you, they are giving their loan to you at a subsidized rate of 14%. Whenever they say the loan is given at a subsidized rate, it means that there will be an element of grants included in the loan. So you have to separate the grants and the loan together. How do you separate it? You present value the cash flows relating to the loan using the what? The rate without what? The condition. So the rate over here, the rate that we are going to use to present value the cash flows is 30%. Okay. So this is just like the coupon rate. The 14% is like a coupon rate, and this is the effective interest rate. Okay. So what we do is that the value of the loan must be equal to the present value of the cash flows discounted at the effective interest rate, which is 30%. So we go and do workings for this particular one somewhere. So let's do workings 2 over here. So we look at the loan. We are looking for the low component, then the grant component. Okay. So the loan component will be the cash flows of the present value of the cash flows. How do you do that? You put the years here. You put your discount factor, which is 30%. You put your cash flow, and you put your present value. So the loan will be repaid in 3 years' time, isn't it? The loan will be repaid in 3 years' time. Is that the case?
Yes.
Okay. Every year you'll be paying interest of what?
14%.
Okay, 14% on what amount?
25.
Okay, so that will give us, what will be the value?
28.
Okay, this will be paid for 3 years, so we can use annuity for this one. So it means that you'll be paying interest of what? 28 every year for 3 years. So we do annuity 1 to 3. In the 3rd year, what will happen? Okay, this will be the discount factor I'll have here. Then the cash flow will come here as 28. At the end of the year, at the end of year 3, what will happen?
Pay the principal.
You repay the loan. So you repay the 200. So let's now use the discount factor to discount these cash flows and now look at what portion will be the loan and what portion will also be the grants. The annuity factor, I'm having 1.816.
Confirm.
Okay. And the discount factor, I'm having 0.455.
Yeah.
Okay. So what will be our present values?
The principal will be 91.
Okay, 91.
And the coupon will be 50.85.
Okay, 50.85. So if we add the two, what are we having?
14185.
Okay, so the fair value of the loan is 141.85. Okay, so what will be the grant components?
So 200. 200
Okay,
minus 141.
okay. So
58.15.
58.15. Okay. So it means that the actual loan given to the company is 141.85. But included in that particular loan, they have given a grant together. So the 200 includes the grant and then the loan component. So you have to separate the two. And separating the two is to find the fair value of the loan component by discounting the cash flows using the what? The rate if there is no condition attached to the loan. Okay. This particular grant is given for a loan, which will last for what? The 3 years. So someone can say that since the loan is for 3 years, I can also recognize the grant over 3 years. Someone can also say that the grant is not relating to an asset. Or, so I can recognize the grant immediately. But you have to see that there is a condition that the company should be in existence for the next 5 years. So it means that before you can get a grant, you have to be in what? In existence for what? For the next 5 years. So someone can take this grant and consume it over what? Over 5 years. So what will happen is that you count your statement of financial position. You now have a loan. Okay, you count your loan. So you now have a loan of 141.85. Then you have uh, government grants or deferred grants because you are here to, so you can say deferred. No, this will be treated as what? As a liability, isn't it?
Yes.
Okay. So the grant will be treated as a deferred. So you can say that will be treated as a non-current liability. So we can say a deferred income or grant because this is like income that you are here to what? You are here to consume. So that will be treated as a liability and that will be 58.15. Okay. If you decide to have a loan of 200 too, there's no problem, but you'll be losing ticks. You'll be losing ticks. You have to be able to separate the loan from what? The grants. What is going to happen? The loan that they are giving to you, what will happen? You are receiving a loan as cash, isn't it?
Yes.
Okay. So if you are, how much are you going to be receiving? You receive all the 200 million, isn't it? Okay. But
Yes.
the question is saying something.
You have to buy a PPE with portion of the loan.
Okay. And that PPE will cost how much?
50% of the amount.
60%.
Okay. So another way of doing this is that you can add the loan of 200 million over here. Then you come and use 60% of it. So 60% of 200 is what?
120.
Okay. So it means that
120.
the current asset will reduce by 120, isn't it? And the PPE will increase by 120. You are just looking for ticks, isn't it? So you just go and add the 200, like the bank has increased by 200. Then you are still using 120 of that money to buy the PP. So you just have plenty figures over there and get ticks. That's all. Or if you like, you can go and prepare the bank account, but that will waste your time. So you can just move on. You can decide to do the workings over here if you are comfortable of the addition and the subtraction. But if you're not comfortable, you can go and do workings and just bring the final figures. Okay. That is all about that particular question. Okay. Let's come to this one.
Now continue.
Yes, please.
C. The directors of Imole have also proposed
Okay.
to
Someone said I should explain the 120. The 120 is the 60% of the 200. 60% of the total proceeds is to be used to buy new production machine. So you use 60% of the money that you are receiving to buy the production machine, which is 60% of the 200. That will give you 120. Okay, senior, you can move on now.
Shall I continue?
Yes, please.
C.
So line is for the 80%. What does it go?
The 40%.
The 80%. Like the 80 runner.
Okay, the 80 we
You know, we
include
have already used.
the 80 is part of the current asset because we
It's
added
part
a
of the current
200.
asset.
We added a 200 before subtracting 120. The bank is part of current assets.
Okay.
So we receive 200, we add the 200 and take the 120 from it. Okay. All right. Yeah.
C.
Hello, senior.
Yes, please.
Yeah, the 120 that we subtracted said an asset. So can't we add it to the? Okay, that's what we added to the PP. Sorry.
Yes, please. All right.
Okay, fine.
The directors of Imole may also propose to acquire another plant facility on lease. They intend to lease the facility for a non-cancelable term of 5 years with annual installment of 10 million Ghana cedis. The first payment starting in 1 year time. Imole's incremental borrowing rate is 28%.
Okay, what is this one? This particular one is about how do we treat this particular transaction, this particular footnote? Okay. So at the date of the transaction, we have to determine what?
Right of
Lease liability.
Okay. We have to determine the right of use and then the lease liability, isn't it? Okay. How do we determine that?
And the present value of the forecast.
Okay. So you can see that the payment is done in arrears, isn't it? So the first payment will be made at the end of the year or 1 year from now or a year from now. Okay, sometimes it can be done in advance. If it is done in advance, we don't present value the first amount that you are paying. We present value the remaining what amount that you'll be paying in the future. So this will be the discount factor will be 28%. And the cash flow is 10 million and the present value. So you can see that this will be done for 5 years. So we can use annuity 1 to 5. What will be the annuity factor? 28%. You can also do it 1 year, 1 by 1. There's no problem with that. You have so many ways of killing a cat, but you have to know that if you don't use your time to kill the cat very well, it will affect you. So I'm having 2.532. Is that correct? Okay. So what will be the cash flow? That will be 25 point what? 30. Okay, senior. So 25.32. So the annuity over here, you can decide to do it one year, but you are using time. You are using time. So just use annuity and move on. Annuity factor is calculated as 1 minus into bracket 1 plus R exponent negative n over R. We use the annuity when the amount that you are paying is constant every year. So your R is the 28%, which is the incremental borrowing rate. Okay. You can also have a question where there will be a reassessment of a lease liability, and they will be giving you incremental borrowing rate. The lease question first in the document. You can try that one, or I will solve it and send it to you. Okay. So the R is the 28%. The N is the number of years that you are going to, or is the number of years that you are going to pay the amount. You are going to pay this for 5 years. So you put your 5 there and find your value over there. So your lease liability is what? Our lease liability is 25.32, and our right of use is also what? 25.32. Okay, so we just recognize this transaction by having right of use over here. So you can put the right of use over here. Okay, someone can decide to add it to the PP. We don't have problem with that. So right of use of 25.32, initial recognition, because this is done today. Then you now have your lease liability of 25.32. So that is actually a lease. This question is about leases. Okay, let's go to the next one.
Lenos,
Yes, please.
because we are preparing the statement on the same date, there is no need for depreciation on the right of use asset.
Exactly. Depreciation and finance costs will be done at the end of the year.
Okay.
So we haven't started using the asset, and we haven't used any year of the grace period. So we can't calculate finance costs.
Okay.
Let's look at the D.
D. Tangible assets into bracket excluding the ones taken over by the directors, Siemens J below, have a revised value of 395 million Ghana cedis, while the unamortized development expenditure is to be written off.
Okay.
Allowance for credit losses of 70 million is to be set up against receivables and inventory written down by.
Okay. So what do we do? They say that the inventory of a certain figure has been taken by who?
Written down by 50 million.
Okay. Okay. So let's now come here. Okay. Before we even before we can adjust the principal assets. Yes, yeah.
Yeah, I don't want you to look like I'm sending you back, but in your explanation about the grant,
Yeah.
you said since it's 5 years based on the arrangement,
Yeah.
someone can decide to divide it into 5 and recognize the year you are working in. But it looks like you recognize all the 58.15.
The year will start from now.
Okay.
So you can only recognize the grant at the end of the year. If you want to recognize for the full year, it means that it will start from today to the end of the year. And we haven't started operation. So the grant will be recognized for a year. So if we have done a year out of the 5 years, then we recognize the grants remaining 4 years. But still we have the 5 years remaining. So that we can't recognize any grants because we haven't done any year out of the 5 years.
Oh, okay.
So I'm saying that someone can decide to take all of them to their capital reduction account as a gain. Okay. But since it's for 5 years, someone can decide to amortize it for 5 years. But depreciation does not start from the date of purchase. Depreciation will be done at the end of the year. The same way grants and all those things will be recognized at the end of the year. You can only recognize over a year. We haven't done any of the years yet. So we still have 5 years. Okay, so we don't do anything. We just put all of them there. Okay, so they say that tangible asset, excluding the one taken over by the director, see note J below, have a revised value of 395 million. So what we do now is that we can only know the value that the directors are taking before we can adjust this particular figure. So we go to the note J and deal with that particular issue, where the unamortized development expenditure is to be written off. So what is the value of the development expenditure? Okay. So if you are writing an asset of development expenditure as an asset, if you are writing it off, what would that be, a gain or a loss?
A loss to the organization.
So that would be a loss over here, development expenditure of 88. Okay. What are the things that they are saying again? They say that we should write certain things off again. Okay. They are saying that allowance for credit loss of 17 million is to be set up against what? Receivables. What are they talking about there? Allowance for what? Bad debt, isn't it? Okay.
Yeah.
Allowance for bad debt is what? It's an expense.
It's an expense.
Okay. So we go to our capital reduction accounts. You see allowance for receivables.
Allowance, can you just write bad debt?
Yes, you don't have any problem. You can even write allowance. There is no problem. Okay. So what is the figure?
17.
17.
Okay. What will be the corresponding entry for this one? Our receivables will be doing what?
Reduce.
Okay. So you go to your current assets and take what? 17. Are we okay?
No.
Yes, please.
We want to ask a question on the grant. That is, so far that we are getting the grant at starting, will there be any factor that will come to the capital reduction account as a gain to us?
If there's what?
You see, with the grant, you are like the subsidy. So at least I was thinking maybe the difference would be like a profit to the organization or something.
Okay.
But this has been capitalized.
Yes. Yeah, Deborah, I want to get your question. What?
With the grant, like they were giving us 30% and they were giving to us at 14%, but the actual on the market rate was around 30%. So I was thinking probably the difference between the rates will be
No, we don't do it like that.
Okay.
We don't do it like that. We just use the effective interest rate to present value the loan. You assume that the loan has been given based on the 30%. So what will be the present value, or what will be the fair value of the loan using that particular one? Okay. Let's take the next one. Okay. They are also saying that an inventory written down by what? 23. Inventory written down by. Are we increasing or we are reducing the inventory?
We're reducing.
Okay. So if inventory is reducing, that will be a loss for the company. So you can even write obsolete inventory over here. Okay. Or you can write impairment of inventory, anything. You can even write inventory over here. There is no issue. So that means that our current asset will still reduce by what? 23, because the inventory is part of the current assets. Okay. Let's now take the next one.
Continue.
Okay.
Yeah, does it mean that the tangible asset you will come back to it later?
Yeah, we'll come back to it. Or if you like, we can take the J. We can take the J now. Okay, let's take the J to finish the tangible asset. Okay. So Sinadeba, take the J for us so that we can finish that one now.
G.
Okay.
Some intangible assets whose current value and market value are 46 million Ghana cedis and 58 million Ghana cedis are to be taken over by the directors through full settlement of the loan.
Okay. So what does this mean? Because we have always been having problem with this particular footnote. Okay. All right. So they are saying that some tangible asset whose carrying value and fair value are 46 and 58 million are to be taken over by the directors in full settlement of the loan. These two values, is it relating to one asset or two different assets or so many assets?
It's the same asset.
Okay. Okay. So that particular asset is having 46 million as the carrying value, isn't it?
Yes.
Okay. But they are giving it to the directors at what?
At 58.
What is happening there?
There's a revaluation gain.
Okay. So there will be a gain of how much?
12.
Okay. So there will be a revaluation gain of 12. Okay. So what will you do? You can go and add a 12 to the PP, isn't it?
Yes.
Okay. Then you come and do what? You come and subtract the 58.
You subtract the 46.
No. We add a 58 to now make it. We add 12 to make it 58 before we subtract the 58 again. But if you didn't add the 12, then you subtract only 46.
Okay.
Okay. So you can see that 12 minus 58 is the same as 46. Okay.
Yeah.
Because I've always been subtracting the 46, but people have been having problem with it. So what you do is that, okay, we assume that we have revalued the asset first to 58. So we go and add a 12 before we give it to the people. So it will be given to them at 58. Then we now remove the 58 from it. Okay. That is the first one. Okay. This 58 is given to the directors for the loan of what?
The director's loan.
What is the value of their loan?
It's 68. 68.
And they are accepting PP of how much?
They are
58.
So what is happening there?
capital reduction.
Okay, there is a gain of 10. So you have the director's loan here. You write director's loan here. There will be a gain of 10. You're supposed to pay them 68, but you are giving them assets worth to the value of what? 58. It means that you are having a gain of this. So director's loan will no longer be the books again. It means that we have settled it. Okay.
Why don't we subtract the 58 separately and subtract the gain separately? Or it's okay.
Okay. We are looking for ticks. No worry. Just look for all the means to get a ticks. So the 58 is for the assets and the 10 is for capital reduction, isn't it? Okay.
Yes.
That is it. All right. Let's now go to the D to finish the D. Okay. They say tangible assets excluding the ones taken over by the directors. See note J. Have a revised value of 395 while the unamortized. So the tangible assets now, let's look for the remaining ones that will be what? After giving those values after giving that one to the directors, what will be our carrying value of the tangible assets now?
Three, 337.
It will be
337. But wait, that line is will be taking the 395 minus
358. It's 358.
okay. It will be 404 plus 12 before minus 58.
Oh, okay.
The 120 is a new asset that we acquired. But what they are talking about is the old asset before the acquisition of the new asset.
Okay.
So it will be 404 plus the 12 minus 58.
Okay.
The 120 that we purchased right now is not part because we can't revalue an asset that we purchased at the beginning of this year. We can't revalue an asset that we purchased at the time of reorganization. So we revalue the existing asset, which will be 404 plus the 12 before you subtract the what? The 58. Or someone can also take 404 and might take the 46 from it because it's only the carrying value of the asset that is included over here. So what are we getting?
No. Yeah.
What is the value?
358.
Okay, 358. Okay.
358.
So, but what are they saying is the value for them?
395.
Okay, so what is the difference?
37.
And that will give us what again, isn't it?
Yes.
We come to tangible assets,
Okay, right one.
37. So what do we do to the assets? We go and add what?
And you ask the
37. Is that okay?
Hello, Linus.
Yes, please.
Okay.
Yeah, please. The loan, treatment of the loan.
Okay.
The difference between the market rate and the subsidized rate,
Okay.
wouldn't it be a gain to us?
No, we don't look for it like that. We use the interest rate to present value. We're just looking for the fair value. Okay.
Okay.
Don't use the 16%. No. You just, the difference between them
okay.
might be a coincidence, but just use the interest rate to present value, the cash flows relating to the debt. Then you now compare with the value that you are giving. The remaining figure will give you the grants. Okay.
Linus.
Yes.
Okay.
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 Even with the amount
Alright,
that we
thank
place at the grant, but can that particular amount be like a gain to us? The grant amount that we set
It's a gain, but will be recognized over 5 years because the condition attached to the loan is that the company has to be in operation for 5 years. So the condition over there is for the grants.
So, Linus, when
Yes.
the condition is met, after how will you be treated?
What you do is that at the end of every year, you assess whether you be in business for 5 years. So you have done the 1 year. You are now sure that you will be in the business, so you just amortize the grant over 5 years. So you divide it by 5 years. Every year you take that portion to profit or loss as other income.
Okay.
All right. So the asset that we are revaluing is the existing asset. You can't revalue. So they say tangible asset, excluding the ones taken over by the director. See note J below. Have a revised value of 395. So the new asset that the new asset that we purchased cannot be revised because we bought the asset at the date of the reconstruction. So we can't revise it. We bought it at their fair value, so we can't do anything. But it's the existing ones that we can revalue. Okay, the 37 is calculated as the revalued value, which is 395, minus what the asset that we have after giving it to. So we have 404. Then we add a revaluation gain before we transfer the asset to them. So this will be the remaining value of the asset that we have after giving the 58 to our directors for their loan. So you compare this particular value with the 395, and that will give you the 37. So the remaining asset over here, which is 358, is now having a revalued value of 395. You have to bring them to their revalued amounts. That will be the difference over there is 37. And you add the 37 to the asset back because you are having only the 358 in the assets there. Okay. Now, Senator, can you take the E now for us?
10% preference dividends are 5 years in arrears. The shareholders have agreed to waive the full 3/4 of the full amount and receive new 20% preference shares for the remaining 10% preference shares are to be reduced to 20%. Each and the remaining capital converted into new 20% preference shares.
Okay. So what they are saying is that there's a preference dividend in arrears for what?
5 years.
Okay. How do we calculate the preference dividends? How do we calculate the yearly dividends? The annual dividends? Yes, please.
Oh, yeah, calculation. 10% of the 80.
Charge the percent on the preference dividend.
So we have 0.8 times what? 80, isn't it?
Yeah.
Is it 0.1? Okay, 0.1 rather. So 0.1 times 80. That will give us 8.
Oh, me.
Okay. But this has been arrears for how many years?
Hello, Linus.
Yes, please.
Please,
For
sorry.
5 years, so multiply by 5.
Yeah, senior. Senior Socrates.
Yeah, Linus.
Yeah.
Yes, please, the footnote D.
Yeah.
The allowance for credit loss. How
Yes.
did we treat it?
It is treated as an expense and taken away from the current assets.
Okay. All right. Thank you.
All right. So let's come to our dividends over here. Our annual dividend will be 0.1 times the value, but this is in arrears for 5 years. So we multiply by 5. That will give us what? 40 million. Okay, what is the question saying? What is the question saying?
Shareholders have agreed to waive 3/4 of the full amount.
Okay. The waive is what? They want to forget about it. But what will happen to the remaining 1/4?
And receive 20% preference shares of the remaining.
Okay. So let's look at the portion that they will be receiving as 20% preference shares. Okay, that will be 1/4 times 40. Okay. And that will give us what? 10 million, isn't it? All right. Okay, this particular dividend, how do we treat it? The treatment will be 10%, 20% preference shares, isn't it? But what will be the corresponding entry?
It will be a loss to us.
Okay. So we debit
because it
capital.
was not recognized in the statement.
Okay, so we debit the capital reorganization. We debit the capital reorganization with a dividend of 10 million. Then we credit our 20% preference shares. So you now have 20% preference shares. Of 10 million. So you just find your dividends, which is 10% on 80, and this has been arrears for 5 years. So you just have to find the total dividend for the 5 years by multiplying the 8 by 5. That will be 40. They have agreed to forget about 3/4, but the 1/4, you have to give them 20% preference shares. All right. Let's take the other part of that particular question there. All right. So they are saying that, okay, and receive new 20% for the remaining. Okay. 10% preference shares are to be reduced to what? 0.2 each, and the remaining capital converted into 20 new 20% shares. Okay, let's now come here. What is the value for the 10% cumulative preference shares? They are waiving. The waiving, we don't have any record on the dividends. So the waiving is something that is not in the books. So how do you cancel it? You can't cancel it, no. So it's not in the books that you have to cancel. If you are recording it in the capital reduction account, what will be the corresponding entry? Okay, so it's not in the books. If they are in the books, then the 3/4 will be treated as a gain because we are owing them 40 million and they are writing 3/4 off. So it means that instead of us paying them 40 million, we are paying them only 10 million. So we are going to be having a gain of what? 30 million. But in this case, we don't have any liability relating to the loan. So we are not paying them any amount. There is no amount in the books. So how do we know that, okay, this is the amount that we have to pay them, and this is what the amount that we are paying them? There's no records. So you can't recognize the 3/4. The 3/4 is already forgotten, and there's no records. We can't cancel anything for it. But it's the one that we are bringing. The one that we are bringing. It's just like you are owing me 40 million, and I've told you that, oh, forget about it. Now you have forgotten about it. Now I'm telling you that, okay, pay me 1/4 of that money. It means that you have to go to somewhere and borrow money and come and pay me. That will be an extra cost to you. And that is what is happening over here. All right. So you can't recognize the 3/4. You forget about it because it's not in the books. Okay. Let's
So now,
count.
if you decide to create a cash book?
If
you decide to create cash, so that you can get the correspondent.
If you decide to create a cash, then it means that you have to bring the dividend to the books before you record the transaction. So first of all, you have to bring the dividend to books. You have to bring the dividend to books before you now cancel it by paying the cash.
Okay.
All right. So the dividend is not there, then you have to bring it as a liability first. If you bring it as a liability, what are you going to do? The dividend is not there. The dividend is not there. So if the dividend is not there, you have 10 million. You are paying 10 million. If you are paying the 10 million, you have to credit cash. But where are you going to get the 10 million to settle? Because the 10 million is not in the books. So it means that you have to first create the 10 million in the books as an expense before you go and settle. Because if you are paying 10 million, if you are crediting cash, what are you debiting? Because you have to pay for something that is already there. You have to pay for something that is already there. The thing is not there. You say you are paying. It means that you are stealing. So the 10 million have to be in the books. You have to create it first by debiting your capital reduction and also crediting the dividend. Then you will now pay. If you pay, then you now debit the dividend and also credit the cash. Okay. So you can only recognize a gain when the dividend is in the books. When the dividend is in the books. Then if the dividend is in the books, it means that you are paying 10 million for what? 40 million. You are going to have a gain of 30 million. Okay, but the dividend is not in the books. It means that you only make provision for the portion that you are paying now. Okay. Let's take the remaining part of that one, then we move on. Okay. They are saying that the 10% preference shares are to be reduced to 0.2 each and the remaining capital converted into new 20% preference shares. So let's go and look at the value of the 10% preference shares. They are issued at what? What is the value per share? Okay. But right now they are saying that it should be reduced to what?
0.2.
So it means that they should be forgetting what?
0.8.
Okay. So we'll be having a gain of 0.8, isn't it?
Yes.
We'll be having a gain of 0.8 per share. So let's go and recognize the gain on the preference shares. And that will be 0.8 times what? 80. Okay. The 0.8 is per share. So you have to find the number of shares first. The shares is 80 million and one share is 1 cedi. It means that the number of shares is still what? 80 million. Okay.
80 million.
Okay. So you multiply by this one. Are we getting 64?
Yes.
Okay. So we subtract the 64 from this place, isn't it? Okay. We reduce it to what?
Okay.
The 0.2 now. So what will be the 0.2?
16.
And they say the 0.2 now should be converted into what? 20%.
20%
Okay.
preference shares.
So it means that you have to remove all the what? 10% preference shares. And now bring the residual value. The remaining value is the 16 after converting. What is the value remaining? That is what they are saying, the remaining capital. That's what they are saying, the remaining capital. Okay.
So, Linus,
Yes, please.
so let's assume that, sometimes they can just tell it to you, like converting the capital into new. Okay, let's assume that they have access instead of the preferred share. They said, okay, it's equity shares. So what I've just added it to the capital, the shares, the 320.
Yes. So you subtract the 16 and add the 16 to the top one, the 320.
So, okay.
Okay. All right. Okay.
So sometimes they wouldn't repeat it. So that's it.
So let's come to the F. Let's come to the F now.
The existing ordinary shares are to be written down to 0.4 each. All ordinary shares are to be consolidated into the shares of 10 Ghana cedis.
Okay. So what is the value? What is the current value of the ordinary shares? They are issued at what?
They are issued at 1 CD.
Okay. But they are saying that it should be reduced to what?
Now we are reducing it to 0.4.
0.4.
Okay. It means that they should forget about what?
0.6.
Okay.
60. 0.6.
So that 0.6 will be a gain to the company.
Yeah.
And so we have the ordinary shares. Because we're supposed to be paying 1 CD. You have accepted 0.4. So 0.6 times 320. What are you having?
192.
192. Okay. So what should be the remaining equity shares? So we just come and subtract the 192 over here, or you can just do the 0.4 times what? Times the 320. You get the answer. And that is all. Okay. They are saying that the
left to 128.
Okay. They are saying that this should now be what? All equity shares
Should
are
be consolidated. Yeah.
Okay.
All ordinary shares are to be
Shares of
consolidated.
10 each.
Okay.
10
So you
each.
can see that the remaining value is what? 128, isn't it? Okay.
Yes.
This 128 now will now be valued at 10 CD. So it means that the remaining shares will now be 12.8 million. You are not going to issue the 128 at 10 CD, but you now convert it to 10 CD. Each share will now be issued at 10 CD. So the number of shares that the company will be having now will be 12.8 million.
Oh, okay.
Okay.
It's not that you go and say that all of them should be consolidated at 10 CD, then you are you are going to multiply at 10 CD. You'll be getting 1280. It means that they are bringing in a new capital, which will be cash. But consolidating means that the remaining shares should now be valued at 10 CD. So the number of shares will no longer be 128 million, but it will now be the value divided by the share price, which will be 12.8 million. Okay.
Linus, please come again.
All right. They are saying that the remaining shares should be consolidated at 10 CD, isn't it?
Yes.
Okay. The question is, what's the remaining shares?
128.
Okay. These shares
128 million.
These shares will now be seen as 10 CD each.
Okay.
So if the total value is 128,
so the 128 million divided by 10.
That will give us 12.8 million. That will be the number of shares. Okay.
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 No.
Okay. 0.8.
Okay. We are done with that part. Let's look at the. I'm just hoping that things will be okay. Because if they try to solve this time around, Then we go to the office and
So this question will come. All these footnotes will come under one question.
So you haven't seen a March one?
Hey.
Or you can go and check.
Hey.
One problem about these people is that they don't audit the questions before bringing them out. Please take the
That's what's happening.
Okay. So the share conversion, they are saying that the equity shares should be written down to 0.4. So it means that the new value of the shares should be 0.4. But the value you have first is 1 cedi. So it is 1 cedi. You are reducing it by 0.6. Okay. You are reducing it by 0.6. So if this year is what? 320 and it is 1 cedi, we are now saying that the shares will not be 1 cedi again. So it should be valued at 0.4. So 0.4 of this will be what? So they can also say it should be reduced to 40%. Okay, so you just do the 0.4 times the 320. That will give you 128. Okay, this is the new capital of the company now, but the capital in the books is 320. It means that what is the difference? The difference is 192, which is the same as 0.6 times the 320. Okay, so the 320 over here will be seen as a gain because we're supposed to be paying the people 320, but they have accepted 128. It means that they are saying that we should keep the 192, which is seen as a gain. So we just do it like that. So instead of you having 320, you will now go and subtract the value of the shares that they are reducing, and that will now bring back to the 128. And this 128, they are now saying that the number of shares that we are going to be issuing to get a 128 will now be at 10 cedi. So how many shares can we issue at 10 cedi to get 128? It will be 12.8 million, which is the 128 divided by the share price. That is all. Okay. Let's move on fast. All right. Deborah, are you there?
I'm here.
Okay. Take
So,
the gym
Jane,
first. Okay.
after somewhat successful discussion with the bank has now agreed to accept conversion of 80% of its claim with 25% secure bond. The remaining 10 into ordinary shares. All 15% debentures are to be converted into 80% unsecured debentures, except the holdings of one unsatisfied debenture investor. The investor is to be paid 75 million Ghana cedis for the full settlement of its claim of 80 million Ghana cedis.
Okay. So they say after somewhat successful discussion with the bank, what item are they talking about over here? Do you have any item relating to the bank over here?
The bank loan.
Okay, that will be the bank overdraft. Okay. So they are saying that after somewhat discussion with the bank has now agreed to accept a conversion of what? 80% of its claim into 25% secured what? Bonds. And the remaining 10 into ordinary shares. How much are they owing the bank?
100 million.
Okay. They are saying that 80% of that should be converted to 25% secured bonds, isn't it?
Yes.
Okay. So 80% of that will give us what?
80 million.
Okay. The remaining will give us what?
20 million.
And they are saying that the remaining should be equity shares, isn't it?
Yeah.
Okay. It means that we are paying the people all the 100 million. There is no gain, there is no loss. Okay. But just that we will not be having bank overdraft in the statement again. Bank overdraft will not be there again. The bank overdraft, 20 million of it now will now be equity shares, and 80 million of it will now be what? 25% secured what? Bonds. Okay. So the bank overdraft will now be converted, and we will be having so I don't have space for the 25% secured bonds. Okay. That should be the 25 secured bonds should be a non-current liability. Okay. But I don't have, let me just,
So it's something new that is coming on the statement.
yes, please.
Okay.
So 25% secured bond. That would be 0.8 times 100, isn't it? Okay. And we come and add 20 to the equity shares, isn't it? So
Yes.
our bank overdraft will now go off because we have converted it to what? 80% is now secure bonds and 20% is now equity shares. So we don't have bank overdraft again. Okay. So let's take the something that they are saying over there. They are saying something over there about some people. Okay. They are saying that all 15% debentures are to be converted into what? 30% unsecured what? Debentures, except the holding of one unsatisfied debenture investor. This investor is to be repaid what? 75 million as a full settlement of its claim of 80 million. Let's now go to the 15% debenture. How much is the 15% debenture?
200.
Okay, 200. Okay. But they are saying that one of the debentures holders is not willing to what? To convert his holding to what? To the 30% unsecured what? Bond. But what is going to happen is that this investor is to be paid 75 million as a full settlement of its claim of 80 million. So how much is the company owing the holder currently?
80.
80. Okay.
80.
Okay. So it means that if we decide to pay that particular person 80 out of this amount, what will be the remaining amount?
120.
220.
Okay. That will be 120, isn't it?
Yes.
Okay. This 120, they are saying that they should be converted to what?
30% unsecured debenture.
Okay. But the debenture who is having 80, how much are we paying him?
75.
75.
Okay. What is happening there?
I'll get a gain of
We've
5.
gained
Yeah,
5.
Gain of
again.
Okay. There will be a gain of 5. So you can write debentures over here or 15% debentures. Okay. 15% debentures. Then you have a gain of 5. Let's now go and record this particular transaction. So you now have the debentures, which is 15. The 200 will now be minus 20 minus 80. Do you agree?
Okay.
Okay. Then we now have 30% what? Let me bring it over here. The 30% also should be a non-current liability, but since we don't have space over here, let me bring the 30% debenture over here. Then this will be 120. Are we okay?
But Linus, yeah.
Yeah.
Hello, Linus.
Yes, I can hear you.
Yes. Once we are paying the person off here, won't it affect current assets?
Yes,
We're
that's what
not
I'm
going
going.
to deduct our
No.
75.
That's what I'm going to
Or
do.
even our bank.
Yeah. So it will affect our current asset. That's what I'm going to do here.
Okay,
So
sorry.
we pay the
Okay.
person to the current assets. Okay. So you are paying the person 75 for a loan of what? 80. There is a gain of 5. So you go and remove all the 80. The remaining 120 will now be converted to 30% unsecured bond. Okay. So that is all about this particular one too. Let's move on to the next one. Then you add the figures. Okay. H. As part of the restructuring, 10 employees have agreed to receive a severance payment totaling to 3 million in exchange for arrangement to have their employment terminated.
No. Hello, Linus.
Yes, sir.
Linus, please
Yes,
hold
sir.
on. The current assets, how much are we deducting?
75.
75 or 80?
75.
Okay.
We are paying 75.
Okay. Thank you.
Okay.
Okay.
Okay. So as part of the restructuring.
Hello, sir.
Yes, please.
So please, does it mean that since you are moving the 80 from the 15% debenture, and we are paying it, wouldn't it affect our current assets?
Yeah, I've taken the 75 from current assets. This is a 75. Have you seen it?
I haven't seen it.
Yeah, it's 75 over 23. Then you have minus 75.
I've seen it. Thank you.
Okay, all right. Okay, let's look at this one. You can see that as part of the restructuring, some people they want to what? They want to terminate their what? Their employment, and the company want to pay them 3 million. Okay. Payment is expected to be made within 3 months. Okay. So let's come to the payment over here. The restructuring. You are going to pay the people 3 million for terminating their contracts. Would this be expense to the company or an income?
An expense.
Expense.
Okay. So you can write a severance payment over here, which is 3 million. Payment is within what? Payment. Okay, so what will happen? We now be having a liability, isn't it? So our payables will be increasing because we have to pay them by cash, but they say we have to pay them in 3 months. So we now add it to our payables. Okay. Let's go to the other part over here. Okay. Payment is expected. A long-term purchase commitment with a value of 100 million is to be terminated at a penalty payment of 0.4 million. So we have a commitment. Maybe we have a commitment with a company that we are coming to buy something from them. So they have kept the item for us. People have come for the item, but they say, well, they are not going to sell because they have a buyer already. Now, as part of the restructuring, we want to terminate it. And they are saying that we should pay a penalty for the termination of 0.4. This 0.4 that we are going to be paying, or we have paid, how should it be treated?
So it will be a loss. It will be an expense. So it will go to capital account, and then we'll also reduce our cash, our current assets.
So we have the penalty of 0.4. But we assumed, the question didn't say anything, so we assume that we have paid it what? Immediately. 0.4. Okay. Let's come to the I. Then we know that we are done.
I. Contingent liability disclosed at 2.6 million Ghana cedis has finally crystallized for 1.9 million Ghana cedis, but the payee has agreed to receive new 1.5 million 25% secure bonds as pre-settlement.
Okay. What they are saying is that there was a contingent liability. Contingent liability can be a court case that the lawyers of the company, they don't know the outcome. So they are saying that just disclose that, okay, currently there is a court case against the company in the court, but we don't know what will happen. But they are saying that this has actually been what? Crystallized. It means that they have now asked the company to pay 1.9 million to the what? To the payee. However, the payee has agreed to what? To receive 1.5 million, 25% secure bonds. The question is, do we have any provision for this particular amount in the statement of financial position?
No.
Okay. Since now we are coming to pay them, it means that that will now be a cost to the company, isn't it?
Yes.
The company will now bring the provision to the books. So what you have to do is that you just bring the amount that they are going to be receiving. So it means that we are going to be paying for a provision that is not in the books. So we have to first make the provision before we pay. So we'll be having 1.4. We'll be having a provision. So let me put it over here. We'll be having a contingent liability So we have a contingent liability of 1.5. And they have accepted what? They have accepted what? 25% what? Secured bond. So we add 1.5 to this one. Okay, that's all. So what you do is you just add this one. This one, we have solved this question before. So this side, yeah, Senior Kobe.
So please kindly take the footnote again. My network went off. Please.
Okay. So they are saying that contingent liability disclosed as 2.6 million has finally crystallized for 1.9 million. But the payee has agreed to receive what 1.5 million, 25% secure bonds as full settlement. So we are saying that a contingent liability is just a liability whose occurrence is based on what? A certain condition, or is based on the occurrence of a particular condition, mostly the court case. Okay, so currently there's a court case that the lawyers don't know the outcome of the court case. So what the company will do is that we can only disclose that, okay, currently there's a court case that we are estimating that, okay, if the things didn't go on well, we are going to be paying 2.6 million. No provision has made for this. Okay. But they are saying that, okay, this has actually been what? Crystallized. It means that the company have to pay the provision now because the case has been lost. So the person has won the case, so they have to pay the provision. And the amount that they have to pay now is 1.9 million. So they have to recognize an expense of 1.9 million and pay the 1.9 million. But the person is saying that, okay, instead of giving me 1.9 million, I want 1.5. So the company will only make provision for the 1.5 as an expense because we are paying the person only 1.5. So you take the 1.5 to capital reduction account, then you now add the 1.5 to what? To the 25% secured debentures because that is what they are accepting for the settlement. So that is how you do. The liability is not in the books. If the liability should be in the books, then you ask yourself, how much should we pay and how much are we paying? That is where you can recognize loss on the what or a gain on a transaction. But this is not in the books and we are now going to pay. So it's like an expense that we are paying for.
Okay, so sir, please, we are debiting the capital reduction accounts, right?
Exactly. It's an expense.
Hello?
It's an expense. Yes, please. We are debiting. Can you hear me?
So let's assume that the contingency liability is close 2.6 million. Let's
Okay.
assume that it was on financial statement. It was
If
on the book.
if it is in the financial statement, then the company will be making a gain of 1.1 because we are using 1.5 to pay for 2.6.
So with that one, we are going to credit we're going to credit capital reduction.
Exactly. Exactly.
Okay.
Okay. All right.
Lionel, so with this one, would something affect the deduction accounts?
Which one? The one that they are talking about now?
Yes, yeah, with the I, would anything affect the deduction account?
It will affect because the provision is not in the books and we are coming to pay. It's a cost that it's a new cost that you are incurring because you haven't make a provision for that particular cost.
So line is here, will the cash be affected too?
No, we are not. They are receiving debentures for the settlement. So we are not paying cash.
Okay. Meaning with this particular one, we'll create provision for it in liability. We'll also add it to the bonds, the secured bonds, and also come and record it in the capital reduction account as well.
Exactly. So you first create a provision. If you create a provision, what is the entries? The provision will be sent to profit or loss. Then you now create a provision in the balance sheet. Okay. So the 1.5 that we are adding to capital reduction is the provision that we have created. Okay, but the provision that we should send to profit statement of financial position is the 1.5 that we are adding to our 25% debentures. Deborah, it's just like you are owing me. The two of us, we have an issue. Okay, we have an issue that we have sent the issue to maybe the king in our area. Okay, the king in the area, they are saying that, okay, we don't know how the issue will turn out. Okay, then you yourself, you are thinking that, okay, maybe you are not going to pay anything, or it is likely that you're not going to pay anything. Now the people have called you that you have to come and pay 300 cedis. That particular 300 cedis is not going to be a cost that you are incurring.
Yeah, of course.
It will be a cost. So if you are a business person, how are you going to be treating that particular cost that you are paying?
It is part of my expenses.
And it will be reducing your cash.
Yes.
Okay, it's the same thing over here. This is just like a new transaction because it has not been in the books. So it's just like a new transaction that we have to bring. So that is how we are doing it. That if it should be profit or loss, we debit profit or loss, then we now credit provision. But they want to receive 25% debentures for that. So instead of us crediting provision, we credit the debentures. That is all. Yeah. So seniors, we just put the figures together, and that is all. All right. Let's look at the first.
Hello, Linus.
Yes, senior.
Please, they accepting 1.5 and we supposed to pay 1.9. Haven't we made any gains?
The question is, do you have the 1.9 in the books as amount that you are going to pay to them?
No.
The gain that you are making is just a notional gain, which is not in the books.
Okay.
And you can't recognize a notional gain. No.
Okay.
So what I did was to record 1.9 on the debit and then a 0.4 to the right. That means I'll not get anything.
You get 6. It means that you are bringing the 1.9 first before you are now paying for them. Okay. So what you do is the best way. Okay, that is it. The best way that is that you can go and make provision of 1.9. So you have a provision in the statement of financial position, and you put the 1.9 at the debit side. Then what you now do is that you now come here. Then you now come here and what? Subtract all the 1.9 and go and add 1.5 to what? To the debentures. It means that instead of you paying 1.9, you are now paying what? 1.5. So you are making a gain of 0.4. So the first one is you can make the provision for the full amount before you now do the settlements. You'll be getting the same thing. Okay. So the one that you have done there's no problem with that. The 1.9 against the 0.4 is the same thing.
That was what I was thinking.
Okay.
Yeah, but since the gain will not be recognized in the, like, maybe in the financial position, you are not going to see the gain there, and even the capital reduction, you are not going to see. What is the essence of just creating the provision account and bringing the 1.9 later, you indicate the 1.5, knowing that the 0.4, you mean 0.4 will not find its way in any part of the
it will come. It will come if it will come. No, it will be notional if you don't create provision for 1.9. It will be notional if you don't create the 1.9, because in actual sense, you should have paid the 1.9 to the people, isn't it? Okay.
Yeah.
So you make a provision. You now bring that particular figure to the books, 1.9 to the books now. So you have a provision in the statement of financial position as 1.9. Then you be having the provision as an expense in the capital reduction account as 1.9. Okay, that is the amount that you should have paid. Now these people that have accepted to receive 1.5, it means that instead of you paying the 1.9, they want 1.5. So you are making a gain of what? 0.4. So that is a situation where you bring the 1.9 as an expense and 0.4 as the gain. And in effect, you'll be having a net expense of 1.5. Okay. If me, I've decided to bring only the 1.5, it means that I'm ignoring the 1.9 and I'm bringing the 1.5 straightforward. I'm not bringing the provision to books. I'm only bringing the payment to the books. That is all. So if you bring only the payment to the books, that will be the notional. All right. So that is that. Let's pick one of the the interpretation questions, which is also another important area for the exam. Okay. Deborah, help us with the top and then additional information. Then we move on.
Interpretation of financial statements. We are a private consultant of Upstown Limited, a listed
Hello, sir.
company.
Yes, please.
No,
Yeah?
before we go, hello, sir.
We should take some break.
Before we go to the
Okay, let's take that one before we move on. Me, I just want to close so that we all go at once. Yeah.
Okay.
Hello.
Yeah, senior.
Yeah. Sorry. Just one last clarification on the last question that you did.
Okay.
I think the point I,
Okay.
the one the where we did the annual dividend.
The I.
You go to the question now. I want to.
Is the
Where
E.
we did the annual dividend.
Yes, please.
No, not the sorry. The point E rather. The point E. You know, after the arrest, there were a calculation where we got 10 million. Seriously, I didn't get that part because my network went off. So
Okay.
you can just show me the calculation.
Okay.
That's all.
They say 10% preference dividends are 5 years in arrears, isn't it?
Yeah, that one I understand. So you
Okay.
multiply the 10% by the 8, you get 8, then you multiply the 8 by 5 to get the 14 million.
Okay.
So from there, that's why.
The shareholders have agreed to waive 3/4 of the full amount and receive new 20% preference shares for the remaining.
Oh, okay.
So they will let go of 3/4, but they will receive a dividend. They will receive 20% preference shares for the remaining 1/4. So you just find 1/4 of the 40, that will give us 10.
Oh, okay. Okay.
Oh, oh.
Thank you.
Okay. So Deborah, take the statement of take the interpretation for us. Let's finish so that we all know that we are done. And me, I have done my part for you. You will go and do your part on next week Monday. That's all. Okay. Deborah, let's move on.
We are a private consultant for Upstown Limited, a listed company in Ghana operating in the manufacturing sector. Below is a statement of financial position in the summarized income statement is comparative for the year ended 3rd December 2022. So this is the 2021 and 2022. So we just go down. Additional information. Total dividends declared and recognized in the financial statement for the year 2022 and 2021 for all shareholders were 35,000 and 35,000 respectively. The balance of retained earnings at January 2021 was 41,000. There was no bonus issue during the year. The only movement in retained earnings for 2022 and 2021 were the profits for the year and the dividend. The company used functional presentation of expenses and attached group expenses into cost of sales, administrative and operating expenses, finance costs, and tax expenses. The disaggregation of tax expenses recognized in the income statement for 2 years as follows. Then, the market price of the company at 31st December 2022 and 31st December 2021 were 1.8 Ghana cedis and 1.5 Ghana cedis respectively. Compute the following ratios of Ashdown: gross profit margin, net profit margin, operating expenses, return on equity, return on capital, current ratio, debt service. And B, prepare a report and address to the chief executive officer. Analyze the financial performance and financial position of Ashdown Limited for 2022 and 2021.
Okay. You see that there are some certain ratios over here. Especially the net profit margin. You can see the net profit margin. You can't calculate net profit margin without knowing your net profits, isn't it? Before interest and tax. Okay. But for the gross profit margin, I hope we can get the gross profit margin from the question. We can calculate gross profit from this question, from these footnotes or this information given to us, isn't it?
Yeah.
Okay. The gross profit is just a sales minus the cost of sales. But can we get our net profit before interest and tax?
No.
Okay. So it means that we have to come and do something. Okay. The question is saying that the only movement in retained earnings for 2022 and 2021 year were the profit for the year and dividends. Okay. So they have given you dividend paid for each of the years, isn't it? And they are giving you the retained earnings balance at the start of the year. Why are they giving you these figures? They are giving you these figures for you to work out the profit for the year. We know that the dividend is calculated as the dividend at the end of the year is calculated as the opening dividend plus the profit for the year. I say the opening dividend, opening retained earnings plus the profit for the year minus the dividend paid for the year will give us the closing retained earnings. So let me show that here. So all of us that are familiar with the statement of changes in equity, balance carried down, which is the dividend at the end, is calculated as opening balance of the dividends. I say dividend. Why do I like dividends like that? Opening balance of the retained earnings plus profit for the year minus dividends paid minus dividend for the year. Then the balance we have now is what? Is the closing balance. This is how the closing balance for retained earnings is gotten. Am I correct?
Yes.
Okay. Okay. So now they give us the opening retained earnings. We want to know the profit made for 2020 what? 2021. So let's go to the question. They have now given us what? They have given us the opening balance for retained earnings at what? January 2021 was 41,000. Okay. So let's now take 2021 balance. Let's now take the retained earnings. Let's find the retained earnings at the end of the year. So for 2021, let's look at year 2021. Okay. We are going to be having the opening balance, which is the balance drawn down of 41,000. What do? We add a profit for the year, isn't it? But we don't know the profit for the year, so we make it X. Okay. What will be the next thing? We take the dividend, what? The dividend paid for 2021. What are we having? The dividend paid, total dividend declared and recognized in the financial statement for the year 2022 and 2021 for all shareholders were what? 35,000 and what? 5,000.
5,000 for 2021.
Okay. Before you also tackle that particular dividend over there, the dividend that they are talking about over here will always be the dividend for maybe the equity shareholders and also irredeemable preference shares. Dividend for redeemable preference shares will be treated as a finance cost, and that will not be part of this one. So we now subtract 5,000. What is the closing retained earnings for 2021? Where can we get that?
60,000. No,
In the
40.
55,000.
55,000.
Okay, that is the closing balance there. These figures are all closing balances. Okay.
Okay.
Okay. So that will be 55,000.
One taking level.
The question now
Go
is,
back. Go back.
okay. So the retained earnings is 55,000. That is the closing balance for 2021. Okay. So the question now is, how do we find a profit for the year? So what will be the profit for the year? Looking at these things, how do we find it?
It will be 36,000 plus X is equal to 55,000.
Okay. 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 So that will give us what?
So that will give us 14 plus 5, 19.
That will give us 19,000. Okay, someone can
Yeah.
also say that this is the same as the 55,000 plus 5,000 minus 41,000. Is that correct?
It will be 55 plus 5,000 minus 41,000.
Okay, and that will give us what? 19,000.
Yeah.
Okay, it's the same as what Branik is saying. The 5,000 will be subtracted against the 41,000 before we bring the 36,000 to subtract it from this. So that will be 19,000. So the profit for the year
Yes.
is 19,000. Okay. Profit for the year is 19,000. But the profit that we need is what? Profit before interest and tax, isn't it? Okay. We will come and look at that later. Let's look at the profit for 2022. The 2022, what is the opening balance?
19,000.
Are you sure?
55,000.
55, sorry.
Okay. So the profit for the year, we don't know. Okay. Then we now have dividends. What is the dividend paid?
35,000.
Okay. 35,000. What is the closing balance?
60,000.
60,000.
Okay. So what will be our profit for the year?
$40,000.
Okay. Okay, that will be 40,000. Okay. Okay. We need profit before interest and tax because we have to calculate net profit margin, return on equity, return on capital employed, and other issues. But we need profit before interest and tax. It means that this profit that we have gotten, we have to come and add finance costs and tax to them, isn't it? All right. Is that the case? Let's look at the issues that we
Yes.
are giving about the tax. Look at what we are giving about the tax. It means that
The requirement is not to get the net profit margin.
Senior, can you come again?
The net profit, is that the net profit before interest and taxes?
No.
I'm saying that we are looking for net profit margin.
We are looking for net profit before interest and
Margin.
tax.
Okay. Okay.
We want to calculate net profit margin, so we need net profit before interest and tax. But the profit that we have gotten over here is the profit for the year, which is profit after tax. It is profit for the year that will be taken to the retained earnings. Okay.
Okay.
So the profit that we have gotten over
Anytime
here.
ask for net profit margin, it means it's profit before interest and taxes, right?
Exactly. We use net profit before interest and tax, unless the question say you should use profit after the year.
Okay.
Okay. Okay. So the profit that we have gotten are profit after tax, which is the profit for the year. How do we get our profit or net profit before interest and tax? It means that we need to know our tax expense and also our finance costs and now add it back towards our profit for the year to know net profit before interest and tax. Let's now come to, we are given the finance cost already. It means that we need to know our tax expense now. Look at how the tax expense is given to us. It means that we have to use the provisions of the IS12 to now calculate the tax for the year. Okay. So if you are adjusting your tax, we always start with the current tax, isn't it? So let's look at 2022 and 2021. Let's do the tax expense. So we always start with the current tax. Okay. What is the current tax for the 2 years?
2022, 14,000.
Okay.
In 2021, 8,500.
Okay. 8,500. Okay. What are the adjustments that we are going to be doing now? overstatement in
Over
2021.
or under. Okay.
Okay. So overstatement in 2021 current tax after tax audit in 2022. This overstatement will be treated in 2022, isn't it?
Yes.
Okay.
Yes.
What is the effect of overstatement on our current tax?
To reduce our current.
Okay. So you go and have the overstatement over here. Okay, the overstatement happened in 2021, but this
The
was
current tax is for 14,000.
it's 14, not 14,500. Okay.
No, it's 14.
Okay. So the overstatement happened in 2021, but we are going to be, or the overstatement happens in respect of 2021, but this is known in 2022. So it will be adjusted against the current year tax for 2022. We don't have any for 2021. Okay. Let's now move on to understatement in 2020 current tax after tax audit in 2021. So overstatement, which is in respect of 2020 will be known in 2021. What is the impact of understatement on our current tax?
We will add it.
Okay. So the understatement will be dashed. That is how much? Is how much
It's
for?
1,000.
Okay, so we add 1,000. Okay. What are the next items?
Decrease in deferred tax for the year.
Okay. The decrease in deferred tax for the year is 2021, isn't it?
Yes.
If there's a decrease in deferred tax, what is the impact on our current tax? Deferred tax is a provision. So if provision is decreasing, what is the decrease is what? Is income, isn't it?
Okay, yes. So
Okay.
we are gaining something.
Okay. So the current tax or tax is an expense. So income against expense, that will be a reduction. Okay. So decrease in deferred tax
Yes.
always decrease our tax provision. So decrease in deferred tax. Okay. So that is how much?
1,005.
Okay. So that will be treated as a subtraction in 2021. So decrease in deferred tax. So 1,500.
Yes.
Okay. Let's come to increase in deferred tax. What will be the
Linus,
impact?
when they just say deferred tax without liability or assets, like, how do you?
If they say the decrease in deferred tax, you assume to be a liability.
Asset.
You assume to be a liability. If it should be an asset, it will be an increase. Okay, so since they say decrease in
Okay.
deferred tax, assume that it's a liability. Because
Okay.
mostly you can't be
Okay.
getting a deferred tax asset like that. So
Okay.
deferred tax. So increase will be what? Will be addition. Because if there's an increase in provision, it means that that will be expense to the company. So what is the increase?
4,200.
Okay. So that will be an addition over here. Okay. Can we calculate our figures now?
Twenty 2022, 17,000.
Okay.
$8,000.
Okay. So can we look for our net profit before interest and tax now? 2021 will be 27,000. Okay. Let's do all of them nicely. So the net profit before interest and tax. We now have the profit after tax for the year. That is 40,000 for these people, 19,000 for these people. So we now have the finance cost. What is the finance cost given to us in the question? $9,000 and $6,000. So 9,000 and 6,000. So you now have the tax expense to be 17,000 and 8,000. What is the total?
$66 for 2022.
So 66 for 2022, and what will be for this one?
33.
Okay, so this will be 33,000. Okay, so from this one, we can now go ahead to calculate our ratios now. Some of them, we can start calculating some of them. So the ratios always use table. Okay, so you put the ratios here, you put a formula here, then you put the years here. 2022 will come first, then you bring 2021 here. So you just put the ratios here, the formula here. Always, if you use table, it will save time. It will save your time. So use table and do the ratio computation in table. Don't do it one by one. It will waste your time. So the first ratio that we are computing is what? Is gross profit margin. Okay. So let's look at the gross profit margin. So you write the formula, which is gross profit over what? Gross profit over what?
Revenue.
Okay. Over revenue times 100. So what is the gross profit for 2022? Can we calculate that? Gross profit.
Gross profit will be sales minus cost of sales.
Okay, and that will give us how much?
For 2022 is 146.
Okay.
146,000.
So 146,000 divided by the revenue of what?
Revenue of 365.
365.
Okay. Times 100. 2021, what is the gross profit?
Is 63.
63,000. Okay, divided by revenue of what?
156.
156,000 times 100. Okay. What are we getting for them?
%40 for 2022.
Okay. 40.
And 40.38. Please, somebody should confirm.
Confirmed.
That is correct.
So let's count to net profit margin will be net profit before interest and tax over the revenue multiplied by 100. So we have calculated the net profit already. We have 66,000 divided by 365,000. Please, for the ratio right now, they are taking a new dimension. Okay. Right now, they are giving you, they will provide you with notes so that you can use the note to explain your ratios. You see, sometimes they will just give you the financial statement without giving you no. So you don't know whether the increase in the net profit margin is as a result of depreciation or you don't know. So you just be saying anything. But right now there will be
Yeah, please, can you go back to the question? Someone is saying something, you want to confirm.
okay.
This for 2021.
Sales
Okay,
is 219,000.
2195. Oh, okay.
No, 219.
219,000.
The figures were wrong.
The one that you have or the one that they have given to us.
No, the one you have used in your calculation is wrong. It's supposed to be 63,000 over 219, not 63,000 over 152.
Not 156.
For which one? The
The
2021 gross profit margin.
I should be 219, isn't it?
Yeah.
Yes,
Okay.
you wrote 156.
Oh, okay. So what would be the percentage?
The answer is correct.
The answer is correct.
No, the answer should be 28. No,
That
27. The answer is supposed to be
28.77.
28.
8.77.
okay.
Okay. So this place will also be 219.
Yes, 219.
Okay. Nice. Thank you. So what will be the answers here?
Twenty 18.08.
18.08. 18.08. Okay. 2021 is what?
15.07.
15.07. Okay. The next ratio is what?
But hello, Linus.
Yes, please.
The net profit, should you always be net profit before interest and tax?
Unless the examiner states otherwise.
Okay.
So it should always be the net profit before interest and tax. Okay. The next one is operating expenses is to sales ratio. Okay. So what is the operating expenses that they are talking about over here? They are saying that the company uses functional presentation of expenses, and as such, groups expenses into cost of sales, administrative expenses, finance costs, and tax expense. Hey.
Linus, sorry, are you getting your figures from?
But people are missing the figures to me. He said that this thing, please, the profit before interest and taxes, 33,500. Is that true?
You wrote it. You wrote it yourself.
Is it 33,500?
We calculated it, so go to the worksheet and let's check.
It was 66,000 and 33,000.
Now, who is saying, please, how did you get your 33,500?
Hey, because I can't see any 500.
Because it's 19 plus 6 and 8. Hello.
Because I don't know. Or the person is using a different,
please come again.
or the person is solving a different question. I say sorry. She's solving a different question.
It's correct.
Okay, she's solving this one. She's solving Apple. I mean, they have given Apple to her, so she's solving different question. It is all. Okay. So they are saying that we should do operating expenses to what? Sales ratio. So look at how the company groups what? Its expenses. So you see that after cost of sales, then we have administrative expenses, isn't it? Which is the operating expenses. So after the operating expenses, we have a finance cost. The meaning is that what is our gross profit? What is our gross profit that we have used? Gross profit is what? 146,000, isn't it? All right. And this is our net profit before interest and tax. So what will be the difference, or what item will come before or will be between the gross profit and the net profit before interest and tax? What figure will be there?
Administrative
30,000.
expenses.
Okay.
30,000.
That will be
2021.
okay.
And then I think 80,000 for 2022.
Okay, that is the administrative expenses. So our gross profit is 146,000. Our net profit before interest and tax. The only figure that we have subtracted from this before getting this will be the operating expenses. That is all. Okay. Someone is look at all this. Hey. Operating expenses is to the sales. So this will just be the operating expenses over sales. You can do over multiply by 100, or you can just do it in the operating expenses over the sales, which is the revenue, then multiply by 100 or something. So our operating expenses will be 80,000 for this one, divided by 365, multiplied by 100. So we have 30,000 over here, divided by 219 times 100%. What are we getting?
2022, 22.22.
22.22%.
Well, how do they expect us to be doing this thinking within that short period to get all these things?
That's why nobody sent you. That is the first thing that you have to know. Nobody sent you. You should have written this as a long time and past, because those days it was very cheap.
Linus, do you know what happened?
Yeah.
I started the ratios first. So about 15 minutes into the work, then I realized, hey, there's something that needs to be deduced. And I went back and I started doing all these deductions and Charlie.
Or sometimes you should just use Takashi. Yeah. You see that, uh, you see, sometimes you just develop the feeling like me, because me, I don't fear any question. Even if I don't understand the question, I'll put Takashi inside and solve it. So, there's nothing that the question are being
Yeah.
sent by someone like you. So why should
Hello,
you?
sir.
Yes, senior.
Sorry to cut you. The answer for 2022 operating overseas is 21.9.
Yeah, it's 21.9 instead.
21.9. Okay.
It's
And
9.2 if you want to maintain consistency.
okay, let's now go to
21.9.
okay. The 2021 is what?
13.70.
Okay. So seniors, just me, I'm very lazy. I don't learn.
70, not 07.
I mean, they are all the same thing. My father is a lotto writer. Let's see. So me, I'm very lazy. But just that sometimes you just have to put Takashi inside. You can't just go there and say that the question. You see the moment you fear the question, that is all. The moment you fear the question, that is all. Just put Takashi inside. If this thing, you will do it. So whatever be the case, you will do it. But as soon as you fear small, the panic, that's all. It will over you. It will over you. So you just have to at least At least it's only 50 marks. Go and hunt for the 50 marks. You can even tell the examiner to give you water, plenty water. And if you take the water, plenty, the energy will come. Whatever,
This cooperation is troubling us.
they have changed
Some of
they
us,
have
I'm
changed the
left to
standard.
cooperate alone. I've been writing it for 3 consecutive times. This is my 4th time.
They have changed the standard. You should have written it long time and past. It's how corporate reporting from the time that they started, very cheap. 2019, you will see the question to be very simple. But right now, if they give you business valuation question, you don't know, you don't. The funny part is that they are loading the question. They are no, it's not right now. There is no easy.
Linus, just to chip this one in, do you know that the business valuation question,
yeah,
they asked us to suggest 4 ways of valuing it, but in the answers that they provided, they gave only 3. They then said they don't know the 4th one.
They don't know the 4th one. You see, that is where we are.
They don't know the 4th one.
They don't audit the questions. The questions, they don't audit it. Instead of you to audit the questions to find out if the things are okay. So you see that most of their solutions, there's a problem in it. They don't audit. They'll just pick the question like that and put it there.
It's true. Sometimes you look at the solution and you're like, some figures are wrong, some things have been put at a different place.
They don't audit the questions. They will just that is why we are as an African. So yeah, let's finish this thing and move on. Let's finish this thing and move on. But whatever be the case, let's finish it. Yeah, it is well. It is well. So the next one is what? Return on what? Equity.
Equity.
So the return on equity is calculated as what?
Profit after tax.
Okay.
Over.
So profit after tax.
Over owner's equity.
Okay. Since you are using profit after tax, it should not just be profit after tax. It should be profit attributable to
equity owners.
Yes. Okay. So
that's profit after tax minus preference dividend.
Okay. Over the shareholders fund times 100. Okay. All right. So what you do is that look at how the preference share is being classified. Where can you see it? Where can we see the preference shares?
It's under equity.
It means that it is irredeemable what? Preference shares. Okay. So you take the dividend from the profit for the year. So the dividend every year will be 5,000. Am I correct?
Yes. That's correct.
Okay. So what is the profit that we have gotten for the 2 years? One of them is 19,000. And one of them is 40,000. So that will be 14,000. So this will be 14,000 for them over the shareholders fund. Can we find the shareholders fund? And this will be 35,000. I hope I'm okay with the 14,000. The profit for the year was 19,000. So we take the dividend of 5,000 from it. This is supposed to be 35. And the other one will be 19. So 35, which is the 40,000 minus that one, and 19,000 minus that will give you 14,000. Okay, let me go to that place again. Okay, look at the profit that we have gotten over here. For 2022 is 40. 2021 is what? 19. These are profit after tax. We haven't taken the irredeemable preference share dividend from it already or yet. So this will be 5,000 against 5,000 against. That will give you 35 and 14. Let's go and get the shareholders fund. Okay. What will be the shareholders fund over here? 2022 give us what?
50,000.
Are you sure? Shareholders fund.
Sorry. 150,000.
The shareholders fund is not only the share capital.
260,000.
No. In the exam hall, is it?
210.
210, 210.
is the equity share capital, and so the devil will not be there and be telling you that it's not there, it's not there.
Yeah, but I don't know why they
is
do all this. Exam pressure. You just take the 260 and you run. Before you realize, Charlie, time
if,
up.
if you want to take the 260, then don't subtract the dividends so that you have a uniform calculation.
Oh, okay.
Okay. So the second one will be, I'm sure the second one will be 25,000. Okay, that will be 155,000. Okay.
Bananas, under what circumstance do you not like? Do you just take you take only share capital? You don't include retained earnings.
No, there's no circumstance that the return earnings is
Like, I mean, what other calculation do you factor only the share capital? You don't include it, or there's nothing like that.
unless the question states that the ratio the ratio should be calculated on only the share capital.
Oh, okay.
Okay. Apart from that one, you pick all the items for them. So these things are
okay.
all
Hello, Linus.
yes, yeah.
Please, this thing, how did you get it? The preference dividends.
It's 10% on their amount.
Okay. All right.
So that is that. Let's look at other.
So it was just coincidence that what they paid in the 2021 was exactly the same thing.
Exactly. Okay.
Okay.
Let's come to return on capital employed. What will be the return on capital employed? How is it calculated?
Profit before interest and taxes.
Okay. Net
Over equity plus long-term liabilities.
See, now it seems like ratio is one of your favorite areas.
And say he has 20 marks secured.
Thank you. So the net profit is 66 and 33. So we have 66,000. And this one, if you want to do it, you include the shareholders what? The shareholders fund also. Okay. The shareholders fund, and you have the shareholders fund. Let's look at this one. So this, we have the 260 over here. 260 plus what? What are we going to add to these figures?
You add
The
55.
long-term borrowing.
Okay. Deferred tax should not be added. Okay.
5 and 93.
Okay.
Hey, you remove the deferred tax.
Okay.
So
Deferred tax is not something that will be generating income. So we ignore it. So we have the 310 over here against what? 305. Okay. Okay, against 295. 310 against 295. So 310 times 100. And this will give us 33,000 divided by 295,000 times 100. Okay. So what are we getting for that? Okay. The next one is the current ratio. Okay. The current ratio, how is it calculated?
Current assets or current liability.
Okay. Current assets over current liabilities. All is to 1. So what is our current asset there?
$130,000.
Yes, that is 130. Okay. $130 divided by our current liabilities is what?
55,000. Or we should add the deferred tax to it.
No.
Okay. The interest.
Hello, sir.
Yes, please.
In computing for the net assets,
Yes, please.
the capital employed, is it not the same as the total asset less current liabilities?
Exactly. But the deferred
But
tax,
when you look at
deferred tax should be taken out.
from the current liabilities,
Deferred tax should be taken away from the figure that you'll be getting.
Because when I did it, I had 305,000.
Yeah.
But when you deduct the deferred tax of 5,000, you have the 310,000.
Yeah. Deferred tax should be taken.
you
Deferred tax,
get 315,000 minus the deferred tax of 5,000.
exactly. Yeah.
Yes.
Deferred tax is not going to, you see, the return on capital employed, what we are talking about is that we are talking about investment that is going to be generating what? Profits.
Okay.
Okay. So if the people are giving you loan, you are going to be using the loan to what? To carry out the business operations. And the money you'll be using it and return will be coming. The equity capital, you are going to be using it. Return will be coming. The return earnings that you are plowing back profits, you are going to reinvest it in the company and return will be coming. So we calculate the return on only those amount of money that are likely to what? To generate return. Or
Okay.
those money that are put in the business purposely for a return. You see their current liabilities are to finance the what? The day-to-day operations of the company. So they are not actually for investment purposes. Okay, but deferred tax, what is deferred tax? It's just a provision that you are making, or it's just something that you are doing because of the matching concept. It's not something that you are going to be paying. It's not something that is going to get a return. So you just forget it and move on. So let's come to the
Okay.
the other. Okay, so we have the 105 and 57,000. Okay, so 105 and 57,000. These are all is to one. These are all is to one. Okay, so let's go to the last one, which is debt to equity. The debt to equity. The debt to equity. Okay. We are going to do a very interesting calculation over here too. Debt to equity. What is the total debt?
50,000.
Are you sure?
Hey, 100,000.
Okay, what are you adding?
The preference share.
Exactly. Preference share is not equity. So it's treated more like a debt. Okay. So if you want to know your debt to equity, we are talking about long-term capital. So the debt will be seen as the interest bearing and then what? The preference share capital. Okay. So
Please come again. Please come again.
yeah, the preference shares. We are looking at debt to equity. Preference share is not equity. Okay, so we are only looking for equity components. So preference shares will also be treated as a debt instrument.
So, senior, are we not adding deferred tax?
No. Deferred tax is not money that you are paying. It's not a debt. Deferred tax is
So
not.
it should be interest bearing debt, right?
Yes, the question will say the debt will be interest bearing. But if that nothing is like that, we use
Okay.
the long-term debt. The long-term debt.
Okay.
Okay. So that would be the interest borrowing 50,000 plus the preference shares.
Linus,
Yes, please.
if the preference shares is debt, then why did you subtract their dividends from the refund, the income?
Their dividend is treated in statement of changes in equity. It's irredeemable preference shares. Okay, we are not going to pay them anytime. So we assume that they are going to be with the company forever like equity. It's not that they are equity. No. Irredeemable preference shares does not give ownership. Only shares that that give ownership are called the equity shares. So preference share is not equity, but just that the classification, the treatment of its dividend is more like what the preference dividend, or the classification is like you are going to be, it is going to be with the company forever. We're not going to redeem it. It is going to be with the company forever. And it's just like equity. Equity will be with the company forever. That is why we treat each dividend as if it is a what? It is equity dividend. It doesn't mean that it is equity. It is still a debt. That's why if you are doing business valuation, you do your total assets. If you do your total asset minus your total liabilities, the total liabilities, you are subtracting what? The preference shares, the redeemable preference shares and irredeemable preference shares. It means that irredeemable preference share is still debt. But just that the classification, that is why we are treating each dividend as if it is the equity instrument. Deborah, are you okay?
So, senior, in calculating your capital employed,
Yes, please.
are you supposed to add the deferred tax?
No, please. There is no way you should add your deferred tax to capital employed. Deferred tax is not part of the capital that we are putting in the business. No. Deferred tax is not money.
Okay, thank you.
Okay, capital employed is just that. What is the money that we have put in the business? That is what we call the capital employed. The money that we have put in the business is the capital employed. Deferred tax is not something that you are putting. It's just a provision. It's just a notional amount, or it's just an assumption to clear your future tax consequences of certain events that are happening today. That is the only thing. It's no amount of money that you are actually going to pay. No. So
that means in calculating your ROCE, you have to exclude the deferred tax.
Exactly, senior.
Okay, thank you.
Yes.
Yeah.
So Linus.
Yes, senior.
Please, if I get you correct, when you are calculating your debt, or let's say, yes, your debt, you should add preference share irrespective of its classification being cumulative, non-cumulative, redeemable, or irredeemable.
Exactly.
Okay.
Preference shares does not give ownership, no matter what name they are calling it.
Okay.
Hello, sir.
Yes, senior.
Another school of thought is saying that in calculating the capital employed, you can just subtract your current liability from your total assets.
That is if there is no deferred tax.
Okay. Okay.
Okay.
That will be a long process.
Okay. In the actual sense, the total asset minus total liability should give you your capital employed, should give you your long-term debt plus your equity funds. But here is the case, we have certain items that are not what? That are not money. Example, deferred tax. So the deferred tax, you should always ignore it. You should always ignore deferred tax. Someone will ask if there is a lease liability. If there is a lease liability.
Employee benefits.
Okay.
In there.
The employee's benefit is actually not amount that you are putting there, and it's not something that is going to give you a return. Employee's benefit is just the money that you are putting, is a future amount that you are making a provision for. This amount, you are not using it to get a return. You are not reusing the amount in the business. The capital employed that we are talking about is that what are the money that we are using to get the profit that we have gotten for the year? That is what we call the capital employed. What are those capital? What are those monies that is giving us the profit that we have for the year? So we put those money together. The money that will help us to get the profit is the debt that we have. Maybe we have taken the debt to buy assets, and we are using the asset to what? To generate revenue. The equity that we put over there, the equity we use it to buy assets, and we are using the asset to what? To generate revenue. Or what are those funds that are put in the business for the purpose of investment? You can also take it from that perspective. The shareholders are putting the money there for a return. The debt holders are also putting the money there for a return. But the employees benefit It's no money that the people are giving to us, but we are just making a retirement plan for them. So you can ignore that one. You ignore. It's not something that is going to attract, or that is there for investment purposes or for return. No. So that is the idea about the capital employed. So you always use the equity and also the long-term debt, because the debt, the people are bringing it over there for return, and that is the interest that you are going to be paying. And the figure that you are using to calculate your ROSI is net profit before interest and tax. So it means that the interest that the people will be receiving is part of the profit. So just add their portion of the debt also. But if you are using profit after tax, then you use only the what? The shareholders fund. That's why the return on equity, we don't include the long-term debt, because interest has been taken out of it. They have taken their portion already. So you don't have any share in the remaining amount. So we can't share it among them. That's how we do it.
Said that return on equity, the shareholders fund.
Yes, please.
In fact, my network went off. How did you get the 21,000 and 55,000?
Okay, the return on the shareholders
Equity,
fund.
the shareholders fund. Only the shareholders fund.
Okay, the return on the shareholders fund is profit attributable to the shareholders over the shareholders fund. Okay, so you see that the profit after tax that we have gotten was 40,000 and 19,000. Okay, they are now paying a dividend, preference dividends. The company is paying a preference dividends of 10%. So every year the preference dividend is 5,000. So we are taking the preference dividend from it, because the preference shares is treated under equity. That means that it is irredeemable preference shares. So we take the dividend from the 40,000 and the 19,000. That was how come we have the 35,000 and the 14,000. And the shareholders fund will be 150, and the equity and the return and its only. Okay.
Okay, thank you.
All right. So let's try and see whether we can finish the other one then. So the other one is the debt to equity ratio. Okay. They say we should write a report analyzing the financial performance and the financial position. Okay. So let's look at the reports writing. So the debt to equity. Okay, it should have been better we do these figures and move on. Okay. Okay, the debt to equity. So let's come to the report writing now. Okay. The report is just, it takes the same format like memo. So you'll be writing to, who are you writing? This will take ticks. It will take mark like 2 marks. Okay. Who are you writing to? Maybe the chief or executive officer or the board of directors. From who? You, the person. You can be the finance officer. Okay. Finance officer. Then what is the date? The date, you can always use the reporting date, the date at the top of the financial statement, or you can also choose any date at all. Then the subject. The subject is the report is about what? What is the heading that you can give to the report? That is the subject. Always maybe analysis of the financial statement and analysis of the financial performance and the financial position of the company. That will be the subject. Okay. So you now come to, after the subject, you come to introduction. You introduce your report. So you can say, as discussed earlier, I hereby present to you the report on the analysis of the financial statement or the financial performance and financial position of this particular company. Okay, this report consider among many things the information provided by financial statements, or this report considers among many things the financial statement presented to you, and also the relevant information about the industry in which the company operates in. If you have certain information about the industry, then you add that one. If you don't have any information about the industry, then you say this report considers among many things the information provided by the financial statement and also information on other relevant competitors in the industry. If you are doing competitor analysis. Just introduction, just introduce it, what we are going to write, and that is all. After that, you come to the body of the letter or body of the report. So in the body of the report, you will now pick the items. So you can pick financial performance. Financial performance will always be the profitability position of the company. Okay, so the financial performance will be the profitability. Okay, so under the financial performance, you can say something small. Okay, the financial performance of the company has been centered on the following ratios. So you can just put the ratios together. Gross profit margin. So if you don't want to put them together as one analysis, you can just list them one by one. Gross profit margin. Then you compare the 2 years, because we are doing 2 years. So let's look at the gross profit margin. The gross profit margin in 2022, or the company is able to perform well in 2022 than what 2021, or the company has performed well in 2022 than 2021. This is because their gross profit margin has increased from 28.7% to 40%. This shows that for every one city sale that a company is making in 2022, they are able to what? Spend only 60 pesos on direct what? Costs, and returning 40 pesos. But in 2021, or however in 2021, the company spent 71.13% on direct costs and was able to return only 20.77 pesos. So that is all, or you can move on to say that, okay, this indicates that the company is able to return maybe 12 pesos in 2022 than what 2021. Then you move on from that place to net profit margin. You talk about net profit margin. What does it mean? What is the ratio? Why are you saying that the company did well in 1 year than the other? What is the meaning of the figures that you have gotten? You come to return on equity. What is the figure that you have gotten? Return on capital employed. What is the figure that you have gotten? You just talk about them one by one. Or you can decide to what? Put all of them together and now just conclude that the company is doing better. If that baby should know what is coming in the future for in terms of the ICA, she will start wearing a gadget. Okay. Or this thing, that particular information given to you over there is no useful for it. Okay. That one that is no relevant for that particular information over there. The market price of the company are this and this. Maybe they can decide to ask you to calculate earnings per share or something, but that is not relevant. Or they can ask you to calculate price earning ratio. Okay, so that is one part of looking at the analysis. You can write the financial performance. The financial performance we center the financial performance analysis on the profitability ratios. So take the profitability ratios: gross profit margin, net profit margin, return on capital employed, return on equity. Then you now take them one by one and explain and what you have calculated. And what is happening is the company doing better in this year than last year, or they did well in last year than this year. Why are you saying that? Because of the figures that you have calculated. You can quote it. Or you can also read meaning to the figures that if it is 20%, it means that every one city of the sale that the company is making, they are maintaining this and this. Okay, so you can take them one by one and explain. Another way is that you can look at the respective ratios. Okay, gross profit margin is favorable in this year. It's favorable in this year. The return on equity, we are not able to get a figure. This one too, we are not able to get a figure. But let's assume that they are all favorable. So it means that the profitability ratios in 2022 are all better than in 2021. So you can just come here and just start with the financial performance and say that, okay, the company, which is Ashtown performed very well in 2022 than 2021. This is because their gross profit margin in 2022 is this percentage as compared to 2021 with this particular percentage. This shows an increment of this figure over the last year's figure. This also implies that for every 1 cedi sale that the company is making in this year, they are able to retain out of that 1 cedi this amount as compared to that. You can also bring in the direct cost, the amount that they are spending on a direct cost. Then you are saying that the company did well in this year than the other year. What is the evidence? Then you are bringing the gross profit margin ratio. The next evidence will be the net profit margin ratio. What have you seen? What is the issues in the respective 2 years? You talk about it. What might be the cause of this one? You can also hit on some causes like the company has increased sales or the company has done some form of advertisement during the year. They were able to utilize their asset very well. That one you can also say that one if you have calculated their net asset turnover. If the net asset turnover for this year is higher than last year, it means that they have fully utilized their assets. You can also calculate the receivables collection period and see whether the company has extended the collection period. If you extend the collection period, it is going to increase your sales. It will encourage people to buy more. So you can also hit on these things as the cause for the increase in the gross profit margin if you have information about them. If you don't have any information, read your own meaning to the information and move on. Just interpret it based on what you have gotten. Write small thing, then you move on. After bringing the gross profit margin, then you bring the next one, which is the return on equity. What is the return on equity telling us? What are they telling us? This is what they are telling us, and this shows that the company did well in the current year than the previous year, as proved by the return on equity. You bring the figures and you bring the meaning to it. You go to the return on capital employed. You are saying that the company did well, and you're using the return on capital employed to support that too. So you bring the figures that you have calculated for the 2 years, and what is the meaning or what is the implication of that particular figure going forward. Then you come to the financial position. The financial position will always be the statement of financial position ratios. The first one will be the liquidity ratios, the gearing ratios, sometimes the working capital management ratios. So you bring because we have calculated 2 ratios, the debt to equity and current ratio. So we can use the 2 to talk about the financial position. What is the debt to equity ratio for this year? What is the current ratio for this year? Is the 2 years favorable than the previous year? If yes, you say that, okay, in terms of financial position, the company has improved upon their financial position in this year than what, or they have improved upon their financial position in this year than the previous year, or there have been an improvement in the financial position of the company in this year as compared to the last year. This is because their current ratio for this year stands at this figure as compared to this figure in the previous year. This means that the company can actually settle its current liabilities 12 times or 3 times in this year than 2 times in the last year. You are move on. You come to the debt to equity. What is the ratio? Is the ratio low? If it is low, that is okay. It means that the company is not having more debt, which is going to have effect on their cash and also their profits. So you talk about them and the capital structure of the company, you move on. Then you come to conclusion and recommendation. For all the things that you have calculated, what can you see? Is the company doing well in this year than last year? That is the conclusion that you can draw from the financial performance. So after all the things that you have calculated, just you few words to conclude. Okay, the company has done well in this year than the last year. And the company has also improved upon their financial position in this year as compared to what? The last year. What is the recommendation? There are some sensitive ratios over there that the company has to work on. One of them will be the current ratio. If your current ratio is not good, it's not looking good, you'll be in a liquidity problem. Because as at when the debt falls due, you will not have cash to settle them. So you have to advise the company on how they should go about the current ratio, how they should improve upon the current ratio. You can ask them to change some of the current liabilities to equity shares, or they should change it to what? Long-term debts. Or you can also ask the company to increase their investment in cash. So you look at important ratios and now advise them how they should go about it. That is the conclusion and then the recommendation. In as much as the report is very important, the calculation of the ratio is also very important, because without the ratio, you can never do a proper interpretation. It is the ratio that you are going to be using to speak. If you are saying that Kofi is doing better than Ama, what is the proof? What is the proof? Bring the proof. The proof will be the ratios that you have calculated. Seniors, that is all. And if you have any other issue, I will be.
Linus, please, you promise to forward some notes to us.
Notes on which one?
We did when we finished the question.
Theory question.
Yeah, reconstruction. You say you have some theory
And
questions.
the reconstruction.
Yeah. Oh, that one there, don't worry. I will send it to you. Don't worry. I will send it right now. My phone is slow. So as soon as I get to the house, I will forward it.
Okay.
So seniors, we will try to meet this one Monday, or we meet Sunday dawn, but we don't solve questions. We just discuss how you should go about the question, what are the things that you do, and we see how far or what God will do on
Which of the Sundays?
No, it's not tomorrow.
Okay, the next. Oh, okay.
Yes, if your calculations are wrong, what are you going to be saying? Because whatever you are saying, you are speaking to the calculation, or you are speaking with the figures. So what are you going to be saying?
Mm-hmm.
So if your ratios, your figures that you are getting are wrong, okay, you will be saying the right thing, or you'll be saying the right thing with wrong figures. Maybe what you are saying is correct, but just that the figures that you are using is wrong. So I don't know how they are going to go about that particular one. Maybe your ratio that you should have gotten for, maybe let's count to the gross profit margin. Okay, the actual figure should have been 25%, and this figure should have been 20%. Okay, maybe you have gotten 27 over here, and you have gotten 22 over here. You see that the interpretation that the person will be giving in respect of this one, the person will be saying that the company is doing better in 2022 than 2021. You will also be saying the same thing with a wrong figure. But if you count to the retention, you'll be having 25 pesos. This will be having 20. But you will be saying that the person is returning what? 27 pesos and 22 what? Pesos. Okay. So another trick that I will tell you is that if you are not sure of the ratio, be using approximation. Be saying that, okay, the company is able to save approximately this figure. That might help you. Don't be using, if you're not sure of the ratio, you are not sure of the figures that you have used, don't use the exact figures that you have calculated. You can just look at it and say, okay, the company is able to return approximately 30 pesos or 35 pesos of all this, or every 1 cedi sales that they are making. You can be using approximation if you are not sure. But if you are sure, then you can just use the correct figures. But whatever be the case, your ratios have to be they have to be correct. They have to, even if they are not correct, they have to be close to correct. All right. Okay. Okay. Seniors, the standards is very important. Try them. Okay. Try the ones that we are not able to do, and
We'll do that.
we see what God will do. Okay.
Thank you very much.
Okay, senior. All right.
So next week Sunday.
Yes, please. I will communicate those. Don't worry. All right.
Thank you.
All right, senior.